Ladies and gentlemen, dear guests, good afternoon. And in name of the Belgian Financial Forum, I would like to welcome you for today's conference that we jointly organized with our esteemed partner organization, Suerf, the European Money and Finance Forum. It's a pleasure to see many guests here today, many experts gathered in Brussels to discuss a topic of critical importance: the evolving relationship between banks and non-banking financial institutions, NBFIs, and its implication for the financial stability. Since the global financial crisis, a key aspect shaping the course of the financial system globally and in Europe has been the growing importance of non-bank financial intermediation. Given the complexity and the interconnectedness of today's financial landscape, understanding the relationship between NBFIs and banks is essential for policymakers, but also for regulators, industry participants. In recent years, much work has been done at international level to identify the systemic risks of NBFIs and formulate potential policy solutions. With this event today, it is our goal to provide to you, the public and the speakers, a unique platform for exchanging views on the evolving dynamics between banks and NBFIs and exploring their implication for the stability of the financial system. Dear public, in the past, the Belgian Financial Forum and Suerf regularly joined forces to host events like this one. We are delighted to rekindle this cooperation, which has always been a source of valuable dialogue and insight. A special thanks to Ernest Gnaan, the Secretary General of Suerf, for his invaluable efforts in making today's event possible. Please join me in giving him a warm round of applause as I kindly invite him to the stage for his part of the welcoming speech.
Hello, ladies and gentlemen. Welcome also on behalf of Suerf, the European Money and Finance Forum. Thank you very much for the warm welcome. My name is Ernest Gnaan. I'm Suerf's Secretary General. Today's topic, banks and financial non-banking institutions, is a very topical one. So what is the aim of today's event? We want to shed light on the evolving relationship between banks and non-banking financial institutions. What are recent trends? What might lie ahead of us? What are the implications for the conventional banks' business models? And how might banks react to this development? What are the implications, opportunities, and risks for customers? Does stiffer competition widen customer choice, improve service quality and lower prices? Or does it also create confusion and involve new risks? What are implications for the stability of the global financial system? How should regulators and supervisors reply, also given the expected deregulation agenda of the new US administration? Before we start, let me thank the National Bank of Belgium and the Belgian Financial Forum for the long-standing close and friendly cooperation with Suerf, including this event. My special thank goes to Frank Liermann, Hans de Griese, and Carmen Boschmans, who actively contributed to this event. It's great to be back in the capital of Europe and of Belgium. For those among you not yet familiar with Suerf, Suerf, the European Money and Finance Forum, is a professional network association among central banks and supervisors, the financial industry, and academic researchers. Suerf focuses on macro, monetary, and financial themes. We bring together policymakers, practitioners, and academics. This way, we encourage mutual understanding and facilitate new insights and solutions. You find Suerf's weekly publications and online in-person events at suerf.org, where you can also subscribe to monthly newsletters. If you become a Suerf member, then you can also subscribe to weekly newsletters. Suerf is financed by member contribution and is open to membership by professional institutions, universities, and think tanks. Feel free to drop us a mail if you're interested. Now, let me directly lead over to today's opening keynote speech, to our opening keynote speaker, Francesco Mazzaferro. As most in this room will know, Francesco is the head of secretariat at the European Systemic Risk Board. What you may not know is that Francesco's career began in the research department at the Istituto Bancario San Paolo di Torino, in Frankfurt am Main and Turin. He then joined the European Commission, focusing on preparations for the introduction of the euro, quite a laborious task. This is when the two of us got to know each other in the first place, so in the early 90s already. And we worked through nights sometimes to get this thing going. We worked door to door from each other, in fact, at the European Commission. Francesco then joined the European Monetary Institute, the forerunner of the ECB, in 1995, where he worked on the euro introduction in 1999, and where we again continued as EMI colleagues. Following various further professional steps at the ECB, Francesco finally took his current role in 2011. We invited Francesco to set the scene for today's conference by providing a system-wide perspective regarding the future role of NBFI financing and implications for financial regulation and supervision. Let me give you a few of the questions that we asked Francesco to answer, and I know that he will answer them brilliantly. So, some of the questions. What are the benefits and risks of diversifying financing resources? What have been recent trends in the role of NBFI financing in the EU? And what might Capital Markets Union bring? How could a diversification of financing resources support financial stability? But also, how could a greater role of NBFIs pose new risks? How should thus financial integration, regulation, and supervision respond? And what might a system-wide approach to regulation and supervision, which focuses on activities rather than entities, look like? De Francesco, we are very curious to hear your thoughts on these important questions. Without further ado, the floor is yours. Please welcome Francesco.
And I move them with the button. So thank you very much, Carmen and Ernst, and ladies and gentlemen, many thanks to the Belgian Financial Forum, the European Money and Financial Forum, Suerf, and of course the National Bank, who's hosting us today, for organizing this interesting event. Suerf is more than 60 years old, but in today's uncertain world, a European forum where market practitioners, central bankers, and the supervisors can exchange views remains as relevant as ever. I am therefore honored and delighted to give one of the keynote speeches at this event. Today, the event will also serve as opportunity to award Suerf's long-standing friend and supporter, Claudio Borio, the Suerf honorary membership. It's therefore only fitting that my keynote speech considers an area where Claudio Borio has provided important intellectual leadership. By way of disclaimer, I must say that the words today are my own, but the main message of my keynote speech, that we need to take a system-wide approach to policy, reflects the views of the European Systemic Risk Board at large. These views are also documented in a report, of which you see the cover on the left, which we have been publishing last November. The topic was also considered by the chair of the SRB, Christine Lagarde at the hearing of the Committee on Economic and Monetary Affairs at the European Parliament recently on 4th December. I will start by considering the benefits and risks that the diversification of funding sources can bring. Let me first comment on why this matters. The EU is faced with existential challenges. They include climate change, an increasing complex geopolitical situation, an aging society, and a growing innovation gap vis-à-vis other economies. Meeting these challenges will cost money. For example, to meet the objectives laid out in the Draghi report, a minimum annual additional investment of 750 to 800 billion euros is needed. Mobilizing private savings need to be part of the solution, but this requires a more diversified financial system that relies less on banks alone. In a recent speech, President Lagarde noted that 1/3 of EU households' total financial assets are held in cash and deposits. In the United States, the figure is around only 1/10. If EU households were to align their deposit to financial asset ratios with that of US households, stock of up to 8 trillion euros could be redirected into long-term market-based investments. This is a flow of around 350 billion annually. Now, as the slides shows, the growth of NBFI, non-bank financial institution, has been important, and we think it's set to continue under the Capital Markets Union. Non-bank financial intermediation has already been growing and now accounts for a little over 50% of total assets of the EU financial system. This trend is likely, as I was mentioning, likely to continue with the relaunch of the Capital Market Union designed to mobilize private savings. Diversification can support financial stability. That entities with different business models pursue the same activities can bring diversification benefits and support financial stability. The EU needs to maintain a strong and resilient banking sector, but the global financial crisis has also showed us that over-reliance on banks can reduce access to finance during periods where the banking sector becomes impaired, putting the real economy at risk. More developed market-based finance can help mitigate this risk, opening up a wider range of funding sources. For example, during the global financial crisis, firms in the United States were able to continue to access credit via bond markets, reducing their reliance on bank credit. In addition to providing an alternative when banks are under pressure, resilient NBFI entities and market-based finance can act as complement to banks during normal times by undertaking different activities from banks or undertaking the same activities in different ways. NBFI entities complete markets and support the overall financial system functions. However, several episodes, of which some recent, have put the resilience of NBFI entities in the spotlights. These episodes are shown on these slides also against an indicator of market stress. Some have been coinciding with global market stress, others are not, were more idiosyncratic. To name but a few, in September 2018, a clearing member active on NASDAQ clearing commodity markets in Sweden defaulted. This, by the way, called for intervention by public authorities at that time. In June 2019, losses on illiquid bonds held by the asset management company H2O, caused a sharp drop in the share price of its parent bank. In April 2021, the collapse of Archegos capital market caused large losses to some major banks. And last but not least, in September 2022, the unraveling of liability-driven investment strategies, LDI strategies, amplified turmoil in the gilt market. These episodes have been, as I would say, often idiosyncratic, and in most cases have not proven to be systemic. Some of them may be perhaps classified as near misses, however. And in any case, they show how interconnectedness allows risks to move through the financial system and how that risk can transform, which together can pose risks to financial stability. Let us recall that financial systems' key economic functions are delivered through a range of activities. They are undertaken by entities and on markets. For instance, the figures on this slide, the slide 8, show just how interconnected and complex the financial system has become. They are drawn from publications of the FSB and also from publication of the SRB. Unfortunately, it's almost impossible to read them in this format. You will have to go to the original. Interconnectedness allows risk to move through the financial system. This can become a problem if opaqueness makes it more difficult to trace and monitor the risk, or if the risk gets amplified because of underlying vulnerabilities in its ultimate holder. For example, the fact that Archegos Capital was able to build up large leverage exposures through its prime brokerage relationship with several banks is an example of such opaqueness and risk amplification. Opaqueness and amplification can increase further when risks get transformed as they migrate. For instance, the unraveling of the UK LDI strategies in 2022 illustrated how the use of derivatives and securities financing transactions can result in market and counterpart credit risk being transformed into liquidity risk. Reflecting this interconnectedness, the European Systemic Risk Board believes that we need to take a system-wide approach. Let us recall, and this is made visible in this table, that financial systems' key economic functions are delivered through a range of activities that are undertaken by entities and on markets. For example, households, firms, and other economic actors need access to payment, settlement, and electronic record keeping. So when transacting, payments are processed safely and swiftly, and ownership and transfer of assets are recorded accurately. They also need access to deposit taking and asset management. This means that when savings deposits are available, when savings and deposits are available for withdrawal and investment assets, they are managed with fiduciary duty. Similarly, there are various activities associated with borrowing and managing risk. Moreover, these activities are not self-contained and often depend on each other. For example, deposit taking, asset management, lending, and capital market financing all depend on payments, settlement, and record keeping. These activities are ultimately undertaken by entities such as banks or non-bank financial intermediaries. This can be through direct contracts between financial entities and counterparts or through markets. The figure on these slides illustrates how this results in a matrix of activities and entities undertaking them. The focus of the legislator has been on entities, and you see the vertical columns. For example, banks and other NBFIs, many of them. When we think of financial regulation, we often think about regulating the entities that are performing them. For example, in the early 2024, EU co-legislators completed the revision of several important entity-based regulations concerning the key NBFI entities. So they did it with finalizing the review of EMIR with central counterparties, Solvency II for insurers, and AFMD for investment funds. Making NBFIs more resilient plays certainly an important element in enhancing financial stability. On its own, however, a focus on entities and the resulting entity-based regulation may not suffice to ensure the resilience of the financial system. This fallacy of composition arises because the level of risk does not increase in direct proportion to the structural vulnerabilities of the entities that make up the financial system. This is because of interconnections and feedback loops. In other words, the whole is more than the sum of its parts. Situations can occur that require macroprudential response, but which, on their own, entity-based regulation cannot easily handle. One such situation arises when the structural vulnerability stems from the volume of activity at the aggregate level. For example, excessive credit growth can lead to overvaluation in property prices, resulting in borrowers becoming over-indebted and ultimately threatening financial stability. So it is also important that we do not only look at this matrix from the perspective of entities, but also from the perspective of activities. Sorry. It is important to stress that looking at this matrix from the perspective of activities does not necessarily mean that one needs to regulate only the activity. That depends very much on whether or not the same activity generates the same risk. For example, as part of their business model, banks can make long-term loans, such as mortgages, and they take short-term deposits. This creates a maturity and liquidity mismatch. This is a structural vulnerability that exposes banks to liquidity risk, and it is therefore addressed by regulation. By contrast, making long-term loans would not expose life insurers to the same liquidity risk. This is because underwriting mortality risk, an activity that is central to the business model of a life insurer, results in liabilities that are long-term and that typically have contractual limitations on lapses. So this is an example where the same activity results in different risk for the type of entities undertaking them. And this is the upper part of the slide. In contrast, when the risks are not entity-specific activity-based, activity-based, it may be useful to have an activity approach. This is why many of the market regulations, I think, for instance, the regulation on derivatives on EMIR, which applies to whoever is entering in the contractual transaction, apply more or less identically to all entities active in these markets. In the report we published in November, the SRB has looked in particular at 3 examples from the perspective of activities. One is asset management, the second is on lending, and the third is on clearing. We have chosen these examples because they are important for the economy, and you can also see from the press cuttings on the slides that they are pretty topical. In the interest of time, let me just focus on one of these activities, asset management. Asset management is central to CMU because it supports long-term funding, market participation, cross-border investment, and resilience, is diverse. It can be performed in various forms by different types of entities, business models, and risk profiles, and can have highly individualized contractual terms. It is multi-layered and intertwined. You may have funds, asset managers, insurance corporations, pension funds. The type of interlinkages with banking sector can be diverse, and that there are long intermediation chains and sometimes high complexity. Asset management is also growing in terms of importance. And the important is that there is much more to asset management than just investment funds. And in fact, the crucial area on which we have been working recently is asset management beyond investment funds. You can see from the left-hand chart, and while granular data on investment funds are available through regulatory reporting, there are a lot of aspects of asset management where we are not yet well sighted on. You can see, for instance, from the question marks on the purple lines that include family offices, sovereign wealth funds, pension funds, other occupational funds, and certain types of discretionary mandates. There are also considerable economies of scale in asset management. As you know, the largest ones are from the US. But as shown in the figure on the right-hand side, there are expectations that consolidation in the EU will also create larger EU firms. Now, vulnerabilities in asset management must be seen in terms of understanding that the general risk that may be associated with asset management are, as I was mentioning, not limited to investment funds. For instance, liquidity mismatch is relevant for open-ended funds, strategic switches in insurance and pension funds to meet liabilities. Leverage, concentration, misaligned incentives. There, you see that these issues are recurring across all forms of asset management. We also need to understand risk beyond investment funds. So in terms of growing volumes, collective nature, interplay between liquidity mismatch and other vulnerabilities. This is typical for funds. And beyond funds, we need to understand a more comprehensive consideration of asset management activities and related risks. In terms of policy considerations, what we need to do is to increase transparency, demystifying known unknowns. So we need to understand, we need to gain a better understanding of various forms of asset management from a financial perspective, financial stability perspective, which means consider introducing reporting requirements beyond the current frameworks. We need to set some common minimum standards for third-party asset managers. From a macroprudential lens, what we need to look at the financial stability perspective to avoid regulatory and supervisory loopholes. In terms of coverage, we have to understand portfolio and risk management, governance, reporting, and disclosure. And in terms of consistency in the policy toolkit, first, we have to draw some lessons from recent policy actions. We have to address some risks originating from various parts of the asset management, understand that doing it might not be feasible with the current tools. And for this reason, probably we need to adapt, reinforce, and broaden the Article 25 of the AFMD, which address leverage-related risk in asset management. And we have to do it also beyond alternative investment funds. Now, turning to the last slides, all of this has to occur on the basis of an evidence-based approach reflecting diversity. Regulation should occur after a thorough risk assessment, considering the variety of business models, understanding risk absorption capacities, and also the different systemic footprint. We should probably set minimum standards, not standardize the rules. One size fits all is not warranted. Regulatory copy-pasting would probably create inefficiencies and stifle innovation. And we have also to understand that we should avoid entity-based overlays. No, we should establish entity-based overlays. Higher standards should be set for entities with more material contribution to systemic risk and avoided for others. And finally, we should not forget that there is a global nature to all of this. I was referring to the fact that asset managers, the largest ones, are not from the European Union. And so we have to actively engage at EFSB level to enhance the transparency and acquire risk of large asset management players typically domiciled outside the EU, including, of course, also, for example, the sovereign wealth funds, which are also from a geopolitical point of view, at the same time, key players, but also actors of sovereignty. I'm finished. And thank you for your attention. I hope it was of interest. And of course, I'm standing ready for questions which you may have. Thank you. Perhaps it's better if you come here so that
I come here. I abuse my privilege to ask the first question, if I may. So I have this interesting slide here in front of me, your system-wide approach, and you picked out asset management as an example. But of course, also lending is quite interesting, and if one reads the financial press, private credit markets are a huge theme right now. Also, there is some notion that there might be a bubble forming in that sector, and that pricing might not reflect risk appropriately. So how do you view this at the ESRB? And my second question would be about clearing. How to consider risks from cyber attacks, because these are quite complex computer systems, basically, the CCPs. So how are there stress tests specifically for cyber risks, for clearing? And then the third question related to your conclusions is global financial interlinkages. You referred to globally operating financial institutions, asset managers, and so on. So how do you consider the risk from fragmentation in the world economic system, but also financial system?
Thank you. I would try to perhaps to respond immediately, because it's already important not to forget the three questions. So I would like to start first on the question of cyber risk, because it's something which is very close to my heart. I'm co-chairing in the SRB. By the way, together with the Bank of England, is one of the few activities where we have been continued to work together. We have been trying to understand what is the systemic perspective of cyber. So what are the situations in which a cyber attack might create such a loss of confidence in the financial market to start propagate, so to speak, type of systemic disruptions. what we have been trying to do on this is, first, we have been trying to add to DORA, and this has been functioning, a systemic chapter. DORA, as you know, has been entering into force on the 17th of this month, so a few days ago. But we have been establishing together with the Joint Committee of the ESAs a system of exchange of information among experts of systemic risk and cyber, bringing the two words together. This system is called SCIF, and it's been established, and I hope it will become more and more operational. And basically is exactly targeted to those cases where we think that at the system level we are faced with risk of a financial disruption of first nature, first dimension. One has also to say that so far we have even not come close to it, in the sense that all in all, the financial system seems to be relatively well defended compared to other sectors of the economy. But of course, we want to be well prepared. In terms of stress test for CCPs, operational continuity and cyber are parts of the stress test which ESMA is regularly doing. Another thing perhaps to add is that operational continuity is becoming per se an important dimension independently of the malign attack of a cyber intruder. So sometimes we have been confronted, this has been happening also last summer, with the problem that the malfunctioning of an update of a software can create broad issues. To a certain extent, probably in terms of frequency of episodes, what we have at the highest level are elementary cyber attacks, the DDoS. So we have then problems coming from updates. For God's sake, we didn't have yet the worst of the possible attacks, which would be the intrusion in systems for a long time in order to hijack data, destroying them, or even worse, falsifying them. The maximum macroprudential impact of cyber would be the one in which you would have the certainty that the market is pricing randomly on the basis of the impact of Trojans, which are modifying the real prices, and in situations which you would not know anymore if you are really cashing profits, you're really doing losses, you would simply have to stop, and you would probably take a lot of time to reconnect, because you would have to have a global conditions of trust before doing it. Reconnection is probably the most difficult situation, in the sense that when you have a problem like this, even if you have solved the engineering part of it, you need to have some institution which is guaranteeing the global functioning of the market. Nobody wants to recognize being basically impacted negatively. On the on the side of private credit, one element which seems to me very interesting is the question on the clarity of the legal obligations. It's quite interesting that recently in the US, the supervisors have been asking operators of the private industry, which basically to certify their own, so to speak, the respect of the legal obligations which they have been taking. So typically, If you are operating in this super complex situation of legal liabilities and rights, what you want to make sure that if a problem occurs, you would discover the day after that in reality the situation was different from the one which you contractually thought to have. Having said that, there are also situations in which private credit could be useful. First, in terms of occupying some, so to speak, angles, corners of the markets which are not populated by banks, because banks are not able to do this type of things. And second, because sometimes there are interesting constellations. So one is, which we are observing with interest, but of course looking at the risk, is the use of matching the illiquid liabilities of insurance with the illiquid nature of long-term credit of private credit companies. Because there, if you can ensure that the matching is real, that the duration is real, that the illiquidity of liabilities and assets is equal, you are not confronted anymore with the problem which you would have with banks, which of course are naturally exposed to liquidity problem. And then there was a question.
The third aspect of global interlinkages
yes.
and fragmentation, be it because of policy steps, let's say about the future U.S. administration, or by sanctions, or this kind of things.
Look,
whether you see any macropotential
look, and we are of course looking now at these issues. I've just finished an internal note which is going to be discussed next week at the technical level. But the reality is it's extremely difficult now to say something. So we need to see first also this evening what is in the executive or executive orders of the U.S. It's clear that, by the way, what you would have is a number of elements which are compounding each other. So one is, of course, the dominating role of the U.S. dollar, the dominating role of the U.S. law and the U.S. jurisdictions, the fact that U.S. law is normally extraterritorial, the fact, of course, that the markets in the U.S. are, in terms of depth and liquidity, much more advanced of what we are. The fact that, as we were saying, that in terms of players in some segments, in terms of, for example, of asset management, what we see is a capacity of U.S. players to gain important shares of our markets, and the great difficulty that our players have to do the same. There are also areas, on the contrary, where Europeans are doing well. For example, one is insurance. So one has to recognize that in terms of insurance, European insurance or European reinsurance is extremely strong, it's dominating. That Solvency II has been very much inspiring the international discussion. We don't have, so to speak, we do not have the same type of international agreements for insurance than we have for banks, but there has been discussions to create something equivalent, and this has been very large set by the European mind.
Thank you. Are there any questions from the audience, please? Yes, please. Please say your name.
Thank you so much. Does this work? Yes. I am Linda van Goor. I'm an independent advisor. Yes, your evidence-based approach, and then your slide 7, which was really a reality check, right? A reality check also if banks have investments and subsidiaries in non-banks. I'm sure you know about the Danish Compromise, otherwise known as the wet dream to many M&A consultants in banks. The Danish Compromise allows banks to risk weight their investments in non-banks with 100%, basically allowing them to use their capital 12 times, multiple leverage of 12 times. Not really available, you know, when shocks like the ones you showed in slide 7 occur. Are you in the Joint Committee of the ESAs discussing revising the Danish Compromise, maybe, in light of the evidence that you just showed?
Look, I mean, it's very difficult to get yes or no question on things on which I'm not sure. So we are not doing it. If the ESAs are doing it, at this stage, I don't know. So it's. But I don't have, at my table, I don't have a chapter which is called Revision of the Danish Compromise. By the way, normally it's Commission which is doing this type of things.
Are there any further questions, please? Well, if not,
I think there
yes,
was a gentleman there.
Hello, Marcus. You stated a lot about the consolidation of asset managers, and one of the big M&As happening in the next.
Can you speak closer to the mic? Sorry.
Yeah, one of the big M&As that is presently happening is the M&A with BlackRock and HPS, a big private credit fund. So, what is the ESRB's M&A regulatory worldview at this moment?
Well, we do, honestly, and there are several of the colleagues here who are at our meetings, so they can testify. We do not discuss specific names. So the type of work which we do is really macro. We don't do it also because the supervisors who are in charge do that job. And it's important not to have double discussions. This creates a lot of problems. So what we have been, of course, in general observing is that there have been a number of attempts. Some are going, some have failed. They may restart and this type of things. But all in all, there seems to be more movement on this than in the banking side. It is perhaps, if I may say, a bit of a paradox, by the way, that we have a single supervisor in the area, which is the one of banking, which remains pretty much national, even within the euro area. So we achieved, so to speak, to have a lot of integration in an area where, by and large, it is. I have to tell you that even for me to open an account, I mean, I have a bank in Germany, an account there since 35 years. I tried to open a bank account of the local branch in Italy. They didn't open to me, and I explained to them, look, I mean, guys, I'm a customer since 30 years, so you should know every payment which me and my wife have been doing it, but it was too suspicious. So they did. So I had to go to a local Italian bank, which opened to me the bank account in basically 20 minutes. But we do not have the equivalent for this industry, asset management, which by nature is cross-border, because it is collecting funds from everywhere. It is investing it everywhere. The investment fund manager can be in country A, and the investment fund company can be in country B. And in fact, they are very much also at the core of the redistribution of capital worldwide. So to a certain extent, I think that there are important reasons to expect that sooner or later, in particular, if this process of consolidations goes on, that we will need to have a stronger form of consolidated supervision at EU level.
I believe I saw the lady behind Marcus, that you had a question. Is that correct, or was it just? Yeah, I think you. Could you please say your name as well? The microphone is behind you.
Thank you very much. Yes, my name is Venia Rekelian. I'm the Greek delegate at CMU. And I have, you just said about the local bank. I think it's not very clear how to buy a foreign mutual fund, for example. We say that we have usage or but it's not clear if double taxation exists, how to overcome some issues. Also, from the client perspective, there is no platform, a website at national level, EU level, I don't know, that combines all the information. What an investor needs in order to diversify. And since we all know and we accept that EU is bank-based, I think what we miss now is the access to investments related to real economy, infrastructure, not listed investments. Thank you very much.
You're right, and I agree with a lot of what you're saying. Having said that, 2 weeks ago, I explained to my mother-in-law that had disinvested from the past in one product and had been buying another one, that she was investing in Luxembourg funds, which were basically replicating Standard & Poor's. She has been basically crashing from the chair, because she thought that she had been simply transforming the book which she had been having for many decades with the post, with something similar without risk. So a lot of these things are already now happening, and would be important to have a look at what are the global implications of that.
Please, gentlemen.
Speak.
Thank you.
So thank you. So my name is Peik Granlund from the Finnish Financial Supervisory Authority. I mean, we talk a lot about advancing the capital markets union. And of course, when you think about it, one kind of natural thing to kind of try to support is the activity of money markets funds. And my question is actually that what, in your opinion, are the measures that we could take in order actually to strengthen the activities of money market funds? Because it's the kind of natural alternative to bank deposits in many ways. And if we want to do this transfer, I think, this would probably be the right way to kind of advance. Thank you.
Thank you. So we have been issuing, so the ESRB does not have hard powers, it has soft powers, and the thing which you can do is issue recommendations. So we have been issuing already 2 recommendations in the course of the life of the institution. And in both cases, what we have been trying to make sure is that one should not create impression that money market funds can deliver a product and a service which is the equivalent to the one of a bank deposit. And in particular, what we think is that there should be liquidity requirements which should be stronger in terms of being able to, let's say, cope with difficult market situations. So typically the money market funds are doing well until basically liquidity disappears. When liquidity disappears, what they are doing is coming to the central bank sector. By the way, central banks have also the complication that have different mandates, so different propensity to respond to it, which inevitably creates also a situation that money market funds end up to be in the constituencies where the central bank is providing them directly or indirectly guarantee, while in those areas where the central banks can only make reference to, so to speak, indirect forms of support, this is less, so to speak, is obviously less rational to develop markets.
We have 5 minutes left. A last opportunity to ask a question, if anybody. Yes, please. Please wait for the microphone.
Thank you. My name is Dirk Bassans, Industrial Commercial Bank of China. You talked a lot about asset management, but moving away from it, today President Trump and his wife each launched their own cryptocurrency. Is the crypto market something, you look at it, because that's definitely a very hidden danger within the NBFI world?
So crypto, I think that we have ourselves to probably to reconsider what we have been saying over time, in the sense that if you go in the website and you see the documents which we have been publishing, one thing which we have been certainly saying is that MiCA is not sufficient, that we would need the MiCA 2, because, by the way, MiCA is not covering a certain important typologies of crypto in particular. It's focused very much on those which are linked to currencies and so on, but not to those which per se do not have an intrinsic reference to value, like Bitcoin and so on. But having said that, a lot of work which we have been doing has been in the sense of thinking that crypto would be a sort of parenthesis in the life of finance. So something which we do not understand well. We do not understand what is the economic rationale while all of this came out, and something which basically would come and would disappear, so to speak. Particular, what has been the general attitude is to say that after all, crypto is nothing as a way to repackage something which has been existing in financial markets since ever. Now, what is happening currently at the political level is clear that crypto has much more political support than this, and that the U.S. administration is signaling it with strength, which of course also implies that investors worldwide will look at it and will react to it. So I can now make a speech in crypto. The people will say, fine, Francesco, it's good. Now we go on YouTube and we listen to the President of the United States, and we compare the two. So we have to think about the fact that, notwithstanding the difficulty to understand what is the underlying value, what the crypto is pricing, and so on, crypto is probably going to be one of the features of the next generation. Crypto and what is coming after crypto now, because I mean, exactly like crypto has been surprising us, there will be something which will surprise those who are working in crypto very soon. So this is, to a certain extent, the rule of the game. So what I will say, one of the difficulty which we have is, also in our job, but in general, is the degree of radical uncertainty to which we are all exposed. The difficulty which we have to elaborate scenarios in terms of one single central scenario and also one single tail risk scenario, the difficulty to assign probabilities to this type of thing. So, and the speed at which all of this is happening is incredible.
Now this concludes our keynote session. Francesco, thank you very much for your excellent presentation and for being prepared to answer so many questions. thanks a lot. And we now turn to the panel. May I ask Hans de Griese to come to the floor and also the panelists, please.
Thank you also from my side, Mr. Mazzaferro, for setting the scene. While everyone is installing himself, I'm going to very briefly introduce our speakers. So it's now time to move on to the next agenda item. Please help yourself also with water maybe before you start. For the next hour, the panel discussion will be organized. We are very happy that we were able to assemble such a diverse panel. We're privileged to have strong representation, both from the banking side and also from the non-banking financial institutions sector. We are welcoming here on stage first Mr. Matti Lepala, Secretary General of Pensions Europe, who will bring a wealth of expertise in pension funds and in their role in financial markets. Mr. Federico Coppelli, Deputy Director of Regulatory Policy at EFAMA, who will offer insights into the asset management industry. Mr. Eric de Montgolfier, CEO of Invest Europe, who will provide perspectives on private equity and venture capital's role in complementing traditional banking. Ms. Thea Utoft, Director General at Insurance Europe, who will discuss the insurance sector interplay. Ms. Michaela Zadler, Director of Banking Supervision and Accounting at the Association of German Banks. And then, last but not least, our moderator, Professor Hans de Griese of KU Leuven, who kindly agreed to guide the discussion. Thank you.
Okay, thank you so much, Carmen, for this introduction. So you already did part of my job of introducing the panelists, the members of the panel. So I'm very honored to chair this session. So as Carmen has said, we have, let's say, representatives of different aspects of the non-bank financial institution on the one hand, but also the banking sector. So we have asset management, we have private equity, we have pension funds, we have insurance, which already shows that, you know, NBFIs are not very homogeneous in the first place. And then, of course, we have the banking sector. And so maybe before starting, so let me maybe think a little bit about, you know, how to structure the discussion. So if you think about, let's say, the NBFIs relative to the banking sector, there are like three views on that. So one view would be, you know, NBFIs simply develop in parallel, you know, to the banking sector, and, you know, that's it. You know, that's where the discussion can end. The other view would be, well, you know, maybe you regulate the banking sector by liquidity requirements, capital requirements, and stuff like that. What is happening is that NBFIs are somehow stepping in, you know, they are substituting parts of the banking sector, and again, maybe we can stop there, okay? So there's some substitution going on. Or the third view, and so this is not my view, this comes from Acharya and Citorelli, is basically saying, look, there is a transformative view, okay? So the fact that, you know, NBFIs and banks are getting interconnected, and we have seen some numbers or some graphs given by the keynote before. And so somehow what is happening is that, you know, due to the regulation of the banking sector, you know, there are exposures created by the banking sector to the NBFIs. And so somehow the entire financial system somehow is still going to benefit, let's say, from the liquidity backstop or from the fact that they have access to the central bank liquidity, for example, or deposit insurance on the other hand. So somehow, you know, the water is somehow, you know, going down the cracks, if you want. And so to steer a bit the discussion with the panel, so we have put up a number of questions before to them. And so the one question was basically the role of banks versus NBFIs in the financial ecosystem, impact on financial stability. So does the growth of the NBFIs, as we have seen, add resilience to the financial system by diversifying risks, or does it introduce additional vulnerabilities? Regulatory frameworks and challenges, and also impact of technological developments or advancements, reshaping the boundaries between banks and NBFIs, and then finally also response to crisis. So the way how we're going to structure the discussion was I basically asked each of the panelists to prepare like an introductory presentation from 5 to 7 minutes. And then my idea would be, that first after that, they can somehow respond to each other, with their like open questions, they can react on each other. And then finally, what I want to do is I want to open the floor for discussion from the floor. Okay, so if you have questions, please prepare them, and maybe then also mention, to whom you want to address the questions. So maybe if you're okay, let me start from the left, my left at least. Go to the most extreme, and maybe you can start with your presentation, let's say 5 to 7 minutes. Thank you.
Thanks, Hans, and thanks for having me in this panel. Really relevant things that we heard in the keynote speech. In pension funds, I think in this debate, we're not the key issue. Financial stability, of course, is really important, but I think pension funds are more stabilizing than many others in the financial markets. The long-term investors, you cannot have a run on a pension fund. So the outputs are quite well known. So there are many factors why pension funds can be counter-cyclical, they can be more stable, but there definitely are links to issues that are really, in the end, systemic risks. And I think in the discussion about liquidity problems that pension funds might face, the use of derivatives is the key issue. As Mr. Matsafer described, the European market infrastructure regulation requires also pension funds to clear centrally derivative positions, and this has been an issue that has been debated for more than 10 years. That how does that market function in a stress situation? How can pension fund have enough cash to post as collateral in variation margins in a time of real stress in the markets? And what is the role of central banks in this? Should central banks provide liquidity to the markets, to pension funds, so that they would not have to sell their long-term assets like government bonds, which could then lead to really serious problems in the market? If we compare to the liquidity crisis in the UK gilt market, we have since the September 2022 discussed quite a bit with ECB, with the Commission, with EIOPA, whether something similar could happen in Europe. And I think we have all concluded that no, in the UK, the gilts and the pension system were much more linked, and this spiral of events could not happen in Europe. The role of derivatives and the role of pension funds as a whole is much more limited, so we don't anticipate that kind of problems. But we do see that even in Europe, in Euro area, derivatives, especially those that are used by the Dutch pension funds, which are really dominating the European pension fund sector, they are sizable, and in a real stress situation, it might be that the market faces problems, especially the repo market, and also in the end could be the money market funds. And then, if then in the end the pension funds would fail their margin requirements and would be unhedged, then this could be a real problem. So I think for the interconnectedness and of pension funds with the banks and the other financial markets, this issue of providing liquidity in derivatives clearing in stress situation remains an issue. And if we look around in the UK, they have now a contingent NBFI system where the pension funds can then borrow cash to post variation margins against their government bonds. In the US, In Canada, they have these kinds of systems where they can provide liquidity. But in Europe, I think the ECB has been reluctant to step in. And I think I've tried to understand, and I guess the logic is that as Europe is so bank-dominated, the financial market is so bank-dominated, then ECB is providing liquidity to banks, and that then should come to the rescue of those who need cash, like pension funds. But I wouldn't like to find out in a real-life situation. I'd rather that we really think this through, and whether, if and when we are trying to push the financial markets to be less bank-dependent and have a stronger role for these other financial market intermediaries, then whether we should really think that we don't end up in a situation where then pension funds in a real stress situation, where everybody is scrambling for cash in that situation, that they would face real problems. I think this is the most important issue for pension funds. I mean, liquidity is important. Pension funds have robust risk management. They have own risk assessment issues. That's all important. But as a whole, I think pension funds do not have, they should not have huge liquidity problems. But this derivative use, which is really concentrated on a few countries, and that I think is part of the problem, that the landscape is so diverse that it is difficult to have clear-cut solutions. But the problem is real and it should be dealt with.
Okay, thank you for the introductory remarks. So maybe now we move to Pia on insurance, so please.
Thank you, Hans. I think you might have placed Matti and I next to each other to kind of scale up to the discussion. No, but first off, thank you for inviting me. So just to give you a little bit of a flavor of how we see things, we don't feel that insurance are just financial services providers like banks and asset managers, but actually that we as an industry play a unique role in covering the full spectrum of life, both for individuals and for businesses, because we are able to give them the confidence that they don't need to bear the losses that they might face on their own. Unexpected events occur, they do both for business and for individuals. And by having insurance, what you're able to do is that you can actually have an economy that works the way it should. We play a critical role in making sure that people can help save and grow their wealth. And we also play a massive role in the markets as an institutional investors. We are maybe not as large an institutional investors as the pension funds, but we are one of the biggest institutional investors in the market as an industry, which has significant, I want to call it, calming impact on financial markets and the long-term economic stability. So I know you've given me 5 and 7 minutes, but if you guys fall asleep for the rest of my introduction, in short, what we're doing is that we're providing financial protection for people and businesses. We're reducing and mitigating risks. We're helping people save for pension and for future. And we're investing in European growth and sustainable transition. And most importantly, we have a stabilizing effect on financial markets and the economy as a whole. But if we boil it down into 3 key points to look at it from, it's insurance has a very different risk profile from banks and other financial sectors, because the underlying fundamentals of insurance profiles are different. We have an inverted production cycle. We get the money on in our hand before we have to settle claims, so that's a very different thing. We have strong and very stable balance sheets, and we have a long-term investment horizon, also due to the nature of the obligations that we're servicing. So that means that the liquidity and systemic risk is typically a lot more limited in the insurance sector compared to the other financial sectors. The other thing is, or the second point is, we are already a highly regulated and highly supervised industry. Francesco mentioned it also in his slide with indicating we have a book that is comparable in size and volume and depth to the one that the banks are compared under in that sense. And that means that both regulation and supervision deals with how we deal with our customers, how we have solvent capital requirements and governance, and there is a significant amount of information that we must disclose to supervisors and elsewhere. Solvency II, you're right, Francesco, it's a very good book and it has inspired a lot of international legislation, and rightly so, because it is a strong regulatory framework. My third point is actually something that I think we also need to look at from the international perspective. We have what we call the holistic framework for the insurance sector that's adopted by the IAS and supported or endorsed by the FSB, which is a framework that identifies and monitors the systemic risk within the insurance sector. So there is a quite substantial book there as well to support it. And this is something that's widely supported both by the regulatory community and the industry, and it's been working really well for the last 5 years. That may not be as long as Solvency II has been working, but it is giving some really clear indications that this is a strong framework. So I want to come back to, and this is going to sound interesting that I'm going to say that on a NBFI panel, but I do believe that when we talk about NBFI, we're probably not talking about the right thing, because what we're doing is that we're defining other actors by what they're not. We have a negative definition of the frame that we're talking about. It's a very broad, very diverse, as you can see by the panel, definition. And it's often included just to say you're not a bank and therefore you're an NBFI. I think there's a very different discussion, and we need to have differentiated approaches to us here on the panel and the sectors that we represent. Because both when it comes to regulation, but also when it comes to the way that Francesco, you said it very, very beautifully, activities doesn't necessarily represent the same risks, same activities, because of the difference of the sectors, because of the difference of the business models. And I feel this is something that often is getting a little bit lost, especially in the political discussions. I'm not going to blame you for that, because of course you guys are doing something else, but it's important to keep in mind that there's no one such thing as an NBFI. And therefore we feel that, when you talk about insurance in this area, I would much rather prefer to have a conversation about insurance than about NBFI as a term, because we are a separate and distinct category, even in this. And I know this sounds like I just feel like a very special snowflake, but it is really because we feel that there's something that we bring to the table that is, if we are looking at these things, which we think is appropriate, we need to look at them in the right way and not get confused with what we're doing.
Okay, thank you. So let's move to our next speaker, which is Federico, and so he's going to talk about asset management. So the floor is yours.
Indeed, another critical actor in this NBFI debate. First and foremost, let me thank the organizers, because I think that they have succeeded in bringing together the different parts of the NBFI all together on one stage. It doesn't happen often, and I think we should be having more of these conversations before an audience of supervisors, NCAs, central banks. So let's keep it up. We did have several points. I'll touch briefly on them and then elaborate a bit more on where IFAMA and the broader asset management industry have been, not only recently, but really across the space of over a decade since the global financial crisis. When we look at banks and non-banks, and with non-banks I mean asset managers being here the IFAMA representative, I think that their relationship is more complementary than it is competitiveness. Essentially because both finance the economy in public and in private markets, and they manage and grow public and private wealth. Now this is done in line with asset managers' key fiduciary duties, which naturally stem from them running an agency business. And secondly, they also do so adhering strictly to client specifications. And here to my left are perhaps our largest clients. Pension funds, the insurers, and there are obviously many, many more, including retail further down the chain. So we serve a very broad plethora of different clients, each with their own risk tolerance, time horizon, and so this industry is very diverse. So diverse that initially when the FSB, in the immediate aftermath of the global financial crisis, set out to label asset managers as potentially GSIFIs, globally systemically important financial institutions, and was looking at the time to apply a methodology to them on the basis of which we would have had very bank-like capital requirements in place. I think that we were successful in having the FSB and some of the central banks represented there rethink. I think we've come a long way since then. I am ever more reassured when I listen to Francesco speak. I think that the understanding of how diverse the asset management industry is now has been better understood. What are the constraints we face, and above all, that we operate in a very diverse environment where we have to interact with not only banks, but we obviously have clients on the other side, and we have other actors as well, notably key financial market infrastructures, just to name one. So I think that there has been an important correction in this narrative. However, if we look at the recent consultation paper put out by the European Commission on a future EU macroprudential regime, I still find that the role of open-ended funds and asset management in particular is a bit still too emphasized, leading me to question sometimes whether certain authorities have fundamentally grasped how different we are from banks. Coming to regulation, here I think that there is already a lot that my industry abides by. It's in Europe, limiting myself to Europe, it's UCITS, it's AFMD, it's MMFR, and then of course, more broadly, we to the extent that we are also market actors, have to adhere to things like MiFID, MiFIR, EMIR, SFDR, the whole lot. This, in my view, is sufficiently enough to capture systemic risks, broadly defined. The question I have there is that given all the information that actors, and not only asset managers, if we think of EMIR, for instance, all the information that is now being sent and shared with supervisors, the question is, where does it end up? Is it being used? Is it being understood? And how can it be better leveraged to make the types of assumptions that we often see? How can it be leveraged to, in the future, map out what the different interlinkages are between all of these very, very different institutions and formulate a macroprudential regime? I have really a lot to say here. I think that if I were to think of the future and thinking about this recent consultation put out by the Commission, obviously we'll see what the new Commissioner will think about this in the next 5 years. But if we just think of where the debate has come in Europe until now, we have this idea, a macroprudential regime that is there to be superimposed and cover those risks that are not yet picked up or addressed by sectoral legislation. I think that we need to be very careful. Firstly, it is crucial that the data is right. It is collected, it is shared, and authorities are able to make sense of it. Sometimes when reading this consultation and in discussions, I feel that the end goal is to have a regime that is imposed top-down, where requirements, who knows, in the future, are going to be decided based on a purely desktop exercise without any industry interaction, or if so, very little. So I would say data needs to be right. Data needs to be right because these interlinkages need to be understood. It's all good to understand the funds, private equity over there, the insurers and the pensions, but then the interlinkages I think remain crucial. And then secondly, unless this is done, I think that the Commission or any policymaker should hold fire and really look at the different parts of the industry and do a cost-benefit analysis. There is a lot that can be harmed if things were to be imposed top-down. Finally, can I just say that in terms of policy approach, although it's far more easy if you do this for one jurisdiction, I would like to praise what the UK authorities have done recently with their system-wide exploratory scenario, the Suerf. It's work that has been occupying their time now for over 2 years. The final report was published late last year. I think it's very good because A, it is an experiment that is capturing only certain financial entities. It's obviously easy if you're in one jurisdiction, but it captures the critical ones across asset managers, insurance, hedge funds, pension funds, CCPs, the whole lot. It's very interactive. From my discussions with my members as well that participated directly, the bulk of the information that informed the Bank of England's conclusions in the end was not picked up from reporting requirements. It came upon ad hoc requests to the industry players that were there to participate. The stress test scenario that was mapped out at the beginning was done substantially with their inputs, and it was tested again a second time with their substantial inputs. So I think that this interactive approach, whatever gets decided in the future, must be respected.
Okay, thank you so much for this view. So let me then move to my right and move to the banking sector. So the other floor is yours.
Yes, so thank you for having invited me as the other part of the sector or the outside part of the sector. There have been a lot of questions before on the point of view of banks on the NBFI sector, and I'm trying to wrap up a few now. Yeah? Numbers, we had them before, but I will come back to them. Numbers we found, according to the European Commission, in 2023, the NBFI sector in Europe, measured in total assets, amounted roughly 43 trillion. The banking sector, 38 trillion. Remarkable. 10 years ago, the relationship was differently. So what do we derive from this? First of all, it's a mere observation. Not good, not bad, not showing of increased riskiness. It is actually a mere sign of an increased need for financing and for a modest development towards something we might like to call capital union. So the fact that NBFIs have outnumbered the banking sector shows of more diversified financing, and that's good news. It's also a result of technological change, we have to admit, and you were better than, and some were better than we were. And last but not least, it's also a consequence of the strong banking regulation after the financial crisis. We were still not allowed to do certain businesses anymore, and you took it over, okay? So, do both sectors have to grow? And does the interconnectedness in between the sectors have to become stronger? Some might say, I say, yes! If we want to finance the European transformation, and if we want to have deeper capital market, this is the way forward. There's no way around that one. Do banks see NBFIs as competitors? It depends on who you ask to. We had long discussions within the European Banking Association on that question. Yes, private credit is growing rapidly. and not always complementing banking activities anymore. If you talk to some credit departments, they're not really happy. They say that they're simply not fast enough due to less regulatory pressure, that they are simply faster, the others, due to less regulatory pressure, and that they are moving into areas of traditional bank lending where they had not been before. At the beginning, it was a lot of mezzanine financing. We liked it. We kept the good part. You took over the risk. But now, you're moving into our fields, and some may see this critically. However, if you talk to others, other parts in the punk, they see great potential for business with all of you. They are happy to business reaching out from different lending activities, from hedging, and last but not least, in securitization, which is a field in which we all want you to grow where we also want to grow. So overall, the EBF has come to the conclusion we see each other as partners. As long as same business, same risk, same rules holds true. And that's something one has to have a look into the details. Do we need more regulation for the NBFIs? From the little we have found out on that. I'm a banking specialist. We're no specialist on your regulation. But if you compare Europe to the rest of the world, that seems very clear to us. We do have a well-designed system of NBFI regulation. And we're still in the midst of implementing it. So we should have a look at what it's going to be like once the latest reforms show their effect. And as a banker, I tell you something. I claim that the banking sector is a very good example of overregulation. We should not repeat that mistake. Here you go.
Thank you. So sorry for mixing up your name. That's already
No
a bad thing. So there is no substitution here. So let me move to the last panelist, which is Eric, and he's going to talk on private equity.
Thank you, Hans. We're glad to participate to this panel, and thank you for the invitation again, and also share our experience of the interaction of our sectors, plural, with banking. This is an important theme. Tackling systematic risk is key to make, obviously, our financial ecosystem stable, as underlined by Francesco, but also to give long-term certainty to investors, which we care about. As a way of introduction, we represent 650 members across Europe, from small venture capital fund managers to large buyout firms, including also infrastructure fund managers. Our GP, what we call GP, which means fund managers members, represent around 60% of the 1.2 trillion assets under management at cost managed by our asset class in Europe. Those are 2023 members, which is actually quite humbling when we saw the figure of 43 trillion that you mentioned earlier. We also represent investors in the asset class, which can also include pension funds, insurance companies, fund of funds, asset managers, as well as banks. So my clients are all there, except Hans. Oh, that's great. Some of our largest members, as you alluded to, may have different types of funds in their portfolio, whether private credit, whether hedge funds, or real estate. But I want to stress that as an association, we only represent their private equity business. Even though our members may have different activities, these are done through different funds, economically and legally ring-fenced from each other, and which are managed by different teams with relevant Chinese walls in place. Private equity as a model is in our eyes necessarily complementary to banks because our members offer a fundamentally different service that banks simply cannot and don't want to offer. By pooling equity capital from a series of investors into a long-term fund, usually closed-ended, our members are able to make long-term active investments in European businesses which banks do not and arguably should not directly make. As such, our industry does represent an additional financial opportunity. I do concur with everybody on the panel that actually is complementary and not in competition for obviously the benefits of Europe. But it's also, and we are also, an investment opportunity for banks themselves to indirectly commit capital to EU growth. Now, it's not because private equity is not at all a competitor to banks that is not interacting with them on some level. Basically, we think that there are two main channels actually through which banks and private equity interact. One, as I mentioned above, was managers and their funds who represent an investment opportunity for banks. However, I would like to note that the recent prudential frameworks have largely disabled the bank's ability to become long-term equity investors, even for the sake of diversification. And just a figure to illustrate that, banks represent less than 5% of overall private equity fundraising in 2023 and 2024, which is extremely limited. Two, banks can provide lending services to the portfolio companies our members invest in, can provide also some debt services to the funds in some specific instances. I can come back to that if we want to actually assess what are the various interconnectivities. I conclude my introduction by flagging that contrary to hedge funds, private equity funds themselves are rarely users of debt, meaning that very often the complementarity between banks and private equity on the debt side relates to the financing of our portfolio companies, your clients, that we support rather than the funds themselves. And if there are exceptions, they represent a very small proportion of that market in amount. But happy to, again, describe a bit more in depth how all this works together. The last comment, we do not trade in derivatives, which is a very big issue and one that has been underlined in some of the troubled children that we've seen on your slides, Francesco, earlier on. We use them when it comes to cover at our banks the request, actually the liabilities of our portfolio companies, but it doesn't go further than that.
Okay, thank you very much. So thanks for all the introductory remarks. So maybe let me try to structure to see whether first people want to react on each other. So maybe let me first ask whether there is a reaction, let's say, among the NBFIs. You know, I mean, there is quite some opportunities. So is there anyone who wants to give a remark on let's say, some of the remarks that have been made on each other? So.
Well, one thing I would like to mention the fact that in this conversation around financial sustainability, we also need to include the need for Europe to be more competitive. That was also outlined in your introduction, Francesco. There's a good balance to find between regulation, irrespective of the form that it takes. We are regulated by AFMD first and U6 second when it comes to our funds, obviously. But I think that we will need more and more private capital to bridge the gap to finance the huge investment needs that Europe has in front of them in the next 5 to 10 years. It's not a one mandate issue. It was way further than that. And it's important to make sure that regulation doesn't come in the way, in one way or another, of our ability to deliver on the policy priorities that Europe has. Against, obviously, we have no particular wish to see deregulation striking. The one we have is actually suits our needs. We have reviewed recently the AFMD, and I think that all the comments that we've made have been taken into account. We're looking at level 1, level 2 now with the various supervisory authorities in place to discuss where all this should go. So I think that it's important also to give a bit of time to essentially look at how the new directive, the revised directive, works out before trying to move a little bit the balance that has been found. It's as you're all aware when you review the directive, it's a long-term effort to reach a consensus, and it's important to make sure that this consensus actually is tested by market conditions and see whether it works or not. We believe it will, but again, I don't want to insult the future.
Yes, please.
Thanks, Eric. Mentioning competitivity and of course then the upcoming savings and investment union and the need to invest in private assets in Europe, in startups, in private equity, venture capital, and very much looking at at investors such as pension funds in doing this. And at the same time, of course, in this NBFI debate for pension funds, as I said, the liquidity issue is a central one. So I hope that we come up with policies that support each other, that we are not on the one hand asking pension funds to make these illiquid investments and then asking at the same time provide more liquidity. And if it's harming the investments, if it comes with too high opportunity costs. So I think it's to have a clear view where we want to go and not to go in diverging directions, because then it becomes difficult. But pension funds need to invest in the real economy. They need to invest in startups. They need to be able to do that long term also in Europe. Pension funds, of course, have invested very much also outside Europe in last years, especially the US market. And we need to do many things to enable pension funds to invest more in Europe, not to force them to invest in Europe, but to have good investment opportunities, and that the liquidity requirements will not pose a problem in this.
I think that's a really solid point, and I think, Michaela, you said it very, very well, in the sense that we're at the end of a large regulation. Looking at it from the insurance perspective, we're actually not at the end of it. We're at level 1. We have at least a good chunk of level 2 that we need to go through as well, and that's one of the places where we see actually that there are some adjustments that's been done to the book that we are under that actually allows us to do more, because it matches some of those activities a little bit better, allowing us to do some things more in the way that we can use our capital. But a lot of these things needs to be filled out by the book that we now are in the process of preparing, and that's where competitiveness is extremely important. But it's also a place where we need to look at fit for purpose of regulation. And I know the level 2 of Solvency II was probably not thought of when the Commission set out their aim of making sure that regulation is fit for purpose. But I think, given that the objective is out there, and given that competitiveness is such a strong driver for European economy, and I agree with you, Michaela, let's all grow. I think that would be wonderful. We'd be very happy up here, sitting here again next year, right? But fundamentally, we need to make sure that we're not running, like getting out over our skis, so to speak. I think that's the one thing, and I think, and maybe it's because I feel this responsibility for the financial stability, because it's such an integrated part of the insurance business model. But we need to be a little bit hesitant in thinking that new regulation and new books can breed these things that the business are actually themselves driven to do already.
Just to echo that, I fundamentally agree. We should not be getting ahead of our skis. There is, however, this tendency sometimes within the Commission to be seen as wanting to do more when, as was said by Eric, we still have AFMD and UCITS, the review, and all the level 2 that has only just begun. That still needs to come over the next 2 years. ESMA has, I think, an almost near impossible feat there, if it wants to observe those timelines. But then also internationally, and this concerns my area more specifically, IOSCO and the FSB have only recently started reviewing their existing 2017 and 2018 principles, respectively, on liquidity risks in open-ended funds. So let's wait, keep any new regulation in the form of macroprudential regime, we'll see, on hold for now, also because the risk is that this additional regulation may end up hitting only one side of the NBFI crowd. So if asset managers get impacted, obviously their cost of business will go up. Investing through them may become less attractive, especially if they see central banks, national supervisors, any public body meddling in their risk management, whereas there are other investors like pensions, like insurers, those that manage and that are able to manage money directly that will simply be not caught by these requirements. So you're going to have a very unlevel playing field. Investors may be incentivized to invest directly and so not entrust their savings, their money, their funds to professional third-party asset managers. So I think that this should be kept in mind as well.
Thank you. So is there any reaction from the banking sector
Yeah.
to...
I would like to give an example of what we can do or which way. First of all, much fun with the level 2. Huh? I can tell you that this is one of the, when we are thinking a lot about our regulation, especially due to this, also due to the changing environment. And to us, it is clear that the so-called final Basel endgame in the US is not going to be implemented in a way where we have done it in Europe. So we are now analyzing and trying to find what are actually elements in the banking regulation we consider not to be healthy for us. This is a really difficult task, I can tell you, because we have many different elements and many of them were created with a certain intention and the intention was good. So I would say the large nails, they should remain. But what's the nightmare is the level 2. Because the level 2 goes into a detail, it tries to create a clarity, but what it creates is thickening box line with auditors, immense processes, and it's really difficult to roll back on that one. So try to get it as principle-based as possible. And I hope for Europe that we will get it as principle-based as possible. So what can we try, where can we now work on all together in order to move along with the Capital Market Union? As you surely know, we are discussing a large package with the Commission and the European institutions on what to do with securitization, which is a field where we can all work closely together. We had many discussions with all of you, especially with insurers, but also with pension funds, asset managers, and we came up with a lot of different proposals on where to head in order to make it easier for investors and for originators. So I hope that's a good example. So this year we will see a good example of how we can draw the regulation back in order to create an upheaval in a certain market.
Okay, thank you. So lots of pushback against regulation, not surprisingly, I would say, given what we are talking about.
I don't think there's pushback against regulation. I think there's pushback on further regulation if it's not offset in one way or another by not deregulation but simplification. And I understand from Ursula von der Leyen's speech a couple of weeks ago that this objective was extremely high in her Commission's list of priorities, and we welcome that because we have the same issue with level 2 stipulations. It's sometimes very, very, very cumbersome, and it adds obviously some compliance cost for our members, which is not insignificant in an industry where you have fund managers who sometimes are 5 or 6 people team investing in Europe on one very narrow sector of technology, and very large, very well-equipped firms that are investing in several segments of the asset management market, including private equity and venture capital or infrastructure, and that have the means, the scope, the scale to actually take in the cost of compliance that is requested from our members. So we have that difficulty in some ways of having to deal with a very diverse size of market players within our industry, and sometimes the regulation is not necessarily proportional, which I think is a very important topic to discuss.
And I think if you'll allow me, Hans, I've been a regulator myself, I've been a supervisor, I've been a policymaker, and it's such an easy pushback to the industry to say, well, of course you don't want to be regulated, but that's what none of us are saying. I think that's really important to underline. it's more about actually we are heavily regulated and we're happy that we are. We're heavily supervised, we're happy that we are. We just want to make sure that we get regulated and supervised in a way that actually allows us to perform our business to the utmost of society's benefit. And I think that's really what's underlying all of this. Yes, we want to run businesses, but we're running these businesses with a long-term perspective. And just to say that we're pushing back on regulation for that sake, I feel that's a little bit too simplified. I like the point about simplification. I like the point about fit for purpose. And I like the point about it making it, as you made, Francesco, making it so that it fits to the specific business model, so that we actually get, at the end of the day, the function that we want to achieve is not regulation, it's the output that comes after the regulation and after the supervision and after the execution. And I think that's the one that we need to keep in mind when we look at these things, because regulation can be many different things and arrive at a goal that is less, let's call it less thought through than it appeared when you drafted the legislation.
Okay, thank you. So maybe I suggest now that we move to the floor and, try to collect questions, or at least, to see whether people have questions. So my suggestion would be, if you have a question, maybe if you want to direct it to someone of the panel, then maybe, tell to whom you want to direct the question, and also state your name and your function, so that we know a bit whom you're talking with. So is there anyone who has a question? Yes, Ernest.
Let me be the icebreaker. I have two questions. One for Thea specifically, that relates to the systemic impact of natural disasters. Now, how would EU insurers be affected by, let's say, an LA type fire? There's also links to the broader topic of massive underinsurance against natural disasters in Europe. That was a big theme a couple of months ago, and of course still is. The second topic is actually relevant for everybody, and I'd be really interested in your insights there, is the impact of artificial intelligence. I'm not an expert on that, but my notion, and Michaela, you indicated a little bit about that, would be that the non-bank financial institutions, at least parts of them, might be further advanced in AI adoption than banks. So how would AI in generally affect your sectors, and is the speed at which you adopt that and the massiveness of the effect for your firms, is this the same or is it different?
Thank you. So maybe Thea, if you want to.
Sure, I can talk a little bit to that. I think one of the things that's I don't know how much people know about the LA situation from an insurance perspective. So maybe let's start with me giving a couple of words about that. So, and again, I represent the European industry, not the American industry. So let's just also take that one off the table. One of the things that is really interesting about the California insurance market is that it's a market where you've seen, well, interesting is maybe not the right word. It's a market where you've seen, and I promise we didn't set this up, a massive regulatory intervention from the legislator's side, which means that you've had insurance companies see increasing demands, increasing regulation, and at the end of the day have found themselves forced to either exit or scale out of market. So that means that if you talk about the insurance, the way things are insured in California, it means that we can see a very clear correlation, and that's also been talked about at global level, between the trend of people basically leaving business because the business is no longer profitable, because the requirements are not matching up so that I can actually run a sustainable business as an industry or as a company. So this is one of the things I think is really important to keep in mind when you look at the insurance coverage in LA. data and all these things around that, I will leave that for the American Association. Happy to give them your phone number and you can have a bilateral conversation. But I think it's really important to keep in mind that we are in the business of insuring. So if we can insure, we will. I think it's really important that we then look at some of the aspects that has to do with, and I think Europe is really interesting to look at natural catastrophe approaches because it's very different from member state to member state. So it looks at different member states have different natural catastrophes that they need to deal with. Some places it's floods, some places it's fires. There are a lot of different ways of approaching this. Some member states have, let's say, early government intervention. One of the things that, and this is me personally having been fairly new to this job, one of the things I find interesting is to look at the nudging factor between early government intervention and insurance. Because it's easy as a consumer to have the impression that the government will have my back. I will get everything covered, but what they forget is that governmental coverage has its limits as well. So I think that's also where maybe there's a conversation that needs to be had about how is that communicated to consumers. From a systemic impact, from what I understand, and again, very early days for me to understand, that actually also in this space, the European insurance companies are, let's say, well capitalized and able to deal with the risks that they take on. I think that's probably the best way I can respond to that at this point in time. But I think, and that's another priority for me, I think we do need to look at natural catastrophe reaction, preparedness, and try and actually go over and see if there is something that can be improved in that, as a whole, the protection scheme for these house owners and other things. And I think if you want to be a little bit cynical and you want to look at the numbers in California and LA, and you want to look at some of the other severe problematic things that are happening with natural catastrophes, I think we might be paying more attention to LA because of the prettiness of the mansions and the prettiness of the people, rather than the actual human impact when you look at things like Katrina and other things. That's a very personal remark. It doesn't reflect the industry, but I think we need to take people with low incomes just as seriously as people with high incomes, and that's what the industry is trying to do. And the only thing I can say is I wish the legislator would help us do that even more. I'll leave the other questions for the rest of the panel.
Yeah.
Maybe I can start with the artificial intelligence from pension funds' point of view. The new legislation, Artificial Intelligence Act for pension funds, is not that crucial. We don't really have these high-risk activities, so the impact is less than maybe for many others. So I think it's been still quite limited, the impact on pension fund industry. It's more machine learning, chatbots, things like this, but less generative AI and large language models. I'm sure it will, and it has to have an impact on every level and every function that pension funds do in the end. The big fiduciary managers for the Dutch pension funds already have a lot in place in asset management part, looking at quant investments, at ESG, analyzing ESG data. I'm sure AI is superior to any other solution. So I think it will fundamentally change the industry, but it hasn't yet.
Anyone else who wants to react to the
Our industry is actually supporting AI investments and have done that for the last probably 15 years when it was not called AI, but something different, machine learning typically. So we are well acquainted with the benefits of obviously using AI, as we've seen that technology and these numerous user cases develop exponentially in the last, let's say, 18 months. So a couple of remarks. One, we do integrate part of AI into our internal processes at firms level as well as portfolio company levels. be it's limited so far by two reasons. One, we started with what is easily actually done, typically some back office functions, some updates or summaries of meetings in order to leave aside some space and some time for our teams. Broadly, it starts to move into not analyzing investment opportunities, but identifying investment opportunities. So we're going progressively from back office to front office. That's underway. But the main limitation is that actually technology is scaling up so quickly that we may actually invest time and resources into one system that will very quickly be outdated. So it's important for us to keep track of what's going on and then choose our fights to make sure that the user cases we are actually applying to our management firms as well as our portfolio company do not get actually binned in a matter of a month or of a few years. Time obviously is important, but our financial resource is as well. So it's ongoing, as you mentioned, for the pension industry. Slightly, maybe a bit more. We embodied it probably a bit more quickly because we knew what was happening actually basically in our businesses, but it's far to be done 100%. I would probably say 20-25% max. For the first time, we created a section on AI on our website. I think it's the first time that we do something between emergence of a trend and actually trying to set up tools that can serve our members as quickly as that. So that's a reflection of what we think about the topic. Pretty cool.
So maybe Michaela?
Banks are embracing it. It has an enormous potential for cost reduction. Back office, it's amazing. We've been discussing solutions with members. I couldn't believe it myself. I thought, oh God, this is going to lead to the massive disposal of a lot of people, to entire value chains in contract verification data, where you had people sitting. They can all be gone. Another important area is coding. Coding is magnificent. You can do, coding has been really difficult because there were no IT specialists. Now you can use large language models and train them for it. When it comes to risk management, it's a little different. This is also where the AI regulation comes from. This is why I'm quite interested in what you said about choosing actually investment. The AI regulation foresees non-discriminatory and explainable modeling. This is a little difficult with black boxes, so you can only use it on a limited space. But also I was explained by specialists that by now they are already working on explaining the black box in order to make it more transparent. So we need to see what this development is going to go to. But in general, it is being embraced by the banking sector, and it's surely going to lead to a significant cost reduction.
Thank you. Is there anyone else who wants to add a note? Don't have to? No? Okay. So is there anyone else who has a question, who wants to take the opportunity? So you have a fantastically diverse panel, so now is your time to shoot and to ask a question. You're all asleep? Is that the idea? I could also ask, but please, yeah.
I didn't dare to ask my third question. So now I do. It links a little bit up to what Michaela mentioned. I think that's what I understood. The revival of deregulatory or regulatory, but actually deregulatory competition globally. So the deregulation drive in the US, what will that have as an effect for Europe? And will this affect the different types of institutions that you represent differently?
You want to start? Yeah, please.
So With regard to deregulation, we've seen it happen even before Trump got elected, re-elected. A zeitgeist of this I saw already when the Commission proposed the new benchmarks regulation, the revision thereto, which fundamentally scopes out 80–85% of all index providers from the scope of the existing BMR. So this obviously creates huge complications. It may look good because we want to get capital allocated. It goes with a more ambitious CMU, but there was the failure there to consider what the consequences would be in terms of asset management disclosures, for instance. So by descoping 80% of the indices that we manage against, we would be caught foul of the SFDR, because we would not have the information from the index providers around our ESG indices, for instance, because the index providers are no longer required to disclose that information. So with one broad brushstroke, BMR2, yay, hooray, the index providers were certainly happy, but we've had to try to renegotiate the text at a late stage. It's just to simply say, yes, fine, let's deregulate, but be careful what you do. A second example of this new zeitgeist, LTIF. LTIF won, as some of you may know, the European Long-Term Investment Fund, came out several years ago. I think it came into force in 2017. Did not manage to collect enough funds as the Commission was initially hoping. Now we have a new text, LTIF 2. The Commission has the ambition to open private assets up to a retail audience. Now, LTIF by definition is an AIF. It's not a UCITS product, so naturally the investors need to be aware before going in. They need to have a certain education, and this is how it has functioned. It was easy for sophisticated investors, high net worth individuals, because they have sophisticated advice that they can pay for. But retailizing this raised many questions. The Commission obviously wanted to open it up, adjusting the portfolio balances, including UCITS-like investments alongside pure private assets. ESMA, on the other hand, came out during the preparation of the RTS as saying, well, hang on, let's not be too open here in terms of designing the redemption rules for these LTIF funds, because there is a risk here that some retail investors may get burned. And so whereas the Commission was saying, well, LTIF would need to, let's say, would benefit from a bit more loose redemption terms, the supervisors, on the other hand, believed that this was an awful mistake. That it came to a head-to-head. The RTSs needed then to be amended. They were in the end, based on the Commission's proposal, and that ultimately got accepted by the co-legislators a few months ago. So there is a bit of a conflict here. Yes, we do want to deregulate. We want to open up more opportunities to the retail investors. There's a lot of talk about how good returns have been in the private asset space. But obviously, there are concerns around investor protection. Investor education, I think, will be critical if LTIF ever takes off as a product where, say, retail investors can, I wouldn't say enter en masse, but maybe start dipping their toes.
Thank you. Is there anyone? Yes.
I have one or two examples I would like to share with you. One is linked to the direct question on the impact of deregulation. For the time being, and since 2016 and Brexit, we have been able to keep virtually no divergence between fund managers that are operating in the EU and more broadly in continental Europe versus the ones that are operating from or in the UK. Which means that it shows that our industry is a global one, where flows of capital are going from one place to the other using the same business model. And that's something that, obviously ESRB are identified, and very rightly so. Capital has no frontier when there's no disincentive to invest it somewhere around the globe. What I fear is that with the wave of deregulation that is promised by President Trump, this will have actually will create a shock of deregulation in the UK, which will create some divergence between how our industry operates, depending on where actually fund managers are based, operating or investing, and will have a direct impact on us in the EU, which can have two consequences. One, we will deregulate and simplify to follow the trend coming from the US, basically in two steps, in order not to be at a disadvantage in terms of competitiveness. Or we stick to our rules, because we believe that they are good, they're working, and that's fine. And then we will lose, by definition, something in the process. Whether it's competitiveness by getting less money available to invest in European businesses, or because our fund managers will consider that they should actually operate under the jurisdictions of the UK or the US instead of staying within our own parameters in terms of jurisdictions and of regulation. And it's a net loss, basically. So I'm not a great fan of the regulation for itself. I think that there are a number of things that we have already flagged a long while ago that could be done better at pension funds level, at insurance companies level, at banks level in terms of capital requirements to invest in the private assets space. I think that this hasn't been consequences of deregulation overseas. It's a question of market participant feedback to authorities saying, if we want to be at least one-fifth or 1/3 of the kind of financial ability to support our businesses we find in the US, we need to do at least a little bit of that in the next 5 years and try to move on to arrive at a level of competitiveness which allows us to get more money from European investors into our asset class, and not only pension funds from Minnesota or Arkansas. And it's not an example, it's reality, investing in Europe to feed better returns to their pensioners. So it's really important to try to see the broader picture. Deregulation may be a result of what happens in the US, but if you look seriously at what we have done and the feedback received, I'm sure we can do something which may eliminate the need for any more deregulation, which in itself is not actually an objective, I think, policy-wise or from a market perspective.
Thank you. So, Matti, you wanted to add something?
Yeah, a couple of remarks. Late last year, the ECB published a financial stability report, and in that it was mentioned that for the first time ever, the investments of pension funds and insurance companies in equity investments were bigger in the US than in Europe. And there are good reasons for that, because the fiduciary duty of pension funds is to pay pensions and to get the best possible returns for the investments. And I think that the reports like Draghi report really highlight the fact that we have made this ourselves by over-regulating, maybe with good intentions and good reasons, and we are maybe right in doing that. But what we have done is we have over-regulated much of our own sector and, of course, the rest of the real economy. So we are not competitive. What's the right solution? How much do we need to deregulate? I'm not sure. But in our sector, the reporting requirements, we are endlessly producing reports and data that nobody cares and is totally unuseful for anybody at any stage. And this comes with a high cost. None of the actors, none of the beneficiaries, none of the consumers benefit any of this. And we can't stop. I don't know what kind of a disease this is, but we are not able to stop. So let's see what happens with this Ursula von der Leyen Commission.
I'm pretty sure everybody of us can make up the list. Reporting is surely a favorite of all of us. We can now play a little game who has the stronger reporting. Huh? I'm pretty sure what he described for the private equity scene is going to happen in any of these industries, because it's the same channels. It works when you are in a deregulatory environment. I really liked his word zeitgeist, because apparently this is the way it goes. When it comes to banking regulation, there were reasons why this banking regulation was as strong as it is today. I have been in banking regulation for the last 23 years. I have gone through all of it, CR1, CR2, CR3. And I believe that there are a few nails in there which are good, and they need to remain in there. This is something we must not forget. But there's a lot of bureaucratism also in there, and the zeitgeist might give an opportunity to do a little cleaning up. But it's not easy to do the cleaning up. It is really not easy. We are trying to having a look at it, and it's difficult not to harm the nails when cleaning up. Huh? Another problem is the Lamfalussy process we are having. We are very slow when it comes to regulation. You know, I cannot come around and say, look, securitization, here's my list. Here, look at it. It's all super convincing. You have to talk to so many players. And there was always going to be a player saying, are you sure if I delete this, that this is not going to impose a major risk? It is slow. The others are much quicker, and that's going to be a problem.
Okay, well, maybe 1 minute.
Very final, there's a glimmer of hope, however, Michele. I think that if we were to look at the political agreement that was reached in December last year on the EU reporting reduction package, I think that that is an early step. And then as far as funds are concerned and fund-related data, there is internal to ESMA a task force that is now working on integrating all reporting requirements from funds. So they are realizing a matrix between all the information that goes to the central banks, that gets reported to the national competent authorities. And I'm happy that we will have a say on this midway this year when a consultation will come up. So I think that the Commission and ESMA have understood that this is a problem and are only now starting to tackle it, which is good. It will give Francesco all the data I think he needs to better assess the macro proof.
It's there. The question is channeling to the right person.
Maybe one final question.
Can you hear me?
Yes.
Yeah. So you have to be telegraphic because we're running out of time. So just be patient. But we've heard a lot of what doesn't work. But from the perspective of financial stability, stroke, systemic risk, stroke, macroprudential frameworks, and I'm going to use that sort of as synonymous for the purposes of this. What is, do you think, the most effective type of regulation, specific tool that you think you would like to see in your area? And which one is the most deleterious, the most negative one? So let's just be very specific, you just give him one. From the perspective of macroprudential financial stability, what's most effective in your specific area and what's least effective?
Thank you. So very briefly, right? So let's...
12 years ago, I would love to tell you that I hated being regulated, but the AFMD struck, and we were captured by that regulation, and we're happy to how it's today put in place and actually supervised by the various authorities locally and on a European basis that are working to make sure that no systemic risk arises from our industry. So I'm fine so far.
Please.
Okay, microprudential, not macro, microprudential capital and liquidity requirements for banks are per se okay and necessary. But what's not okay and necessary is the detailedness with which it breaks down to level 2 and level 3. And there you can take a lot of away.
I would say that what exists today is fine. It has got us a long way. I would question a lot of the narrative that puts open-ended funds as being these systemic propagators of risk. I think that if we look at the crises, March 2020, the LDI event, or even this big spike in rates in early part of 2022, it's hard to say that the open-ended fund industry, their bond funds in particular, and money market funds actually had problems to the systemic in a systemic way. From a macroprudential perspective, what we certainly do not want to see is public bodies telling asset managers how to run their liquidity tools, activating them, deactivating them, what should be the conditions. And I think that there's still parts of this in the Commission's recent consultation, for instance, where there's a question asking whether ESMA, in coordination with the ESRB, should come in where market volatility picks up and say to money market fund managers, here, these are going to be your liquidity requirements, raise them because the situation calls for them. And this would be impossible to manage a portfolio against. And so then it obviously creates the types of threshold effects, potential moral hazard that we've seen elsewhere.
I will be very telegraphic. I will go Solvency II and Solvency II in the sense that, and then of course also underline, as we said before, we appreciate the holistic macroprudential oversight framework. That's, again, to the point about deregulation, it's an international framework, which is also very helpful.
For pension funds, the regulatory framework is different than I think for others, because the European legislation is minimum harmonization for pension funds, as Solvency II and many others are maximum harmonization. So we don't have level 2 for pension funds. It's much more up to the member states to define. And as part of this framework, we think that we have a good requirements for risk management and own risk management based on European legislation requirements, and we think that works quite well, and not really there is a need. There really isn't a need for like a harmonized European approach. And linked with that, I think the worst thing that we would see could think about would be a harmonized, too detailed, rules-based approach that would not understand the specificities and the differences of pension funds across Europe. So really, we are quite happy and don't think that we think that we are dealing with those risks that pension funds pose in liquidity and other issues.
Okay, thank you so much. So let me stop here. So we wanted to stop in time, but of course then we had a macroprudential intervention, so which was very good. Thanks for that. So let me thank all the panelists for their contribution, and thanks again. Thank you.
Thank you.
Dear public, as a third agenda item and the last session before the coffee break, I'm very pleased to announce you our next speaker, Mr. Jean-Paul Servet, Chairman of FSMA and of the IOSCO board. Mr. Servet kindly agreed to share his insights on the regulatory challenges and opportunities also posed by MBFIs. His contribution today will undoubtedly also bring an international dimension to the discussion. Please join me in welcoming Mr. Jean-Paul Servet to the stage.
So, good afternoon, ladies and gentlemen, and dear colleagues and friends. First of all, thank you for inviting me to this conference, this high-level conference, and allowing me to explain the role and perspective of IOSCO. I have to say that the timing is perfect to be invited on a Blue Monday to speak about shadow banking and NBFI. That's perfect. Hopefully, I think, frankly speaking, excellent news from IOSCO and also from our partnership with FSB, which is something rather new and even expected, if I may be a little bit non-politically correct. The question is, of course, first of all, why IOSCO? Maybe I would say the new kid in the town who had expected that IOSCO would be there. In fact, is it really a surprise? I don't think so for two reasons. First, the mission statement of IOSCO, established exactly the same year than the other committee, not located in Madrid but in Basel, the Basel Committee. We have three parts of our mission statement: consumer protection, I would say investor protection, fair and transparent financial market, but also, I would say, to have an added value about financial stability. But I have to say, acknowledge that I would say the last part was maybe less, I would say, important when we start the successful story of IOSCO. And we are more and more switching to that, I would say, and also with in-depth and a deep dive about retail, cross-border retail investor protection. The second reason why I think, but of course I'm not objective as IOSCO chair, even if I think that I'm quite willing to say that IOSCO doesn't have to be on the stage about everything, but I don't think also that it's not a surprise for a second reason, because IOSCO, it means the capacity to tackle global risk, opportunity, and challenges. And that's the case, because I'm not sure that everybody knows that IOSCO, it means a real global membership organization with 130 jurisdictions on board, and all our members, CFTC, SEC, BaFin, IMF, IFM, IFSC Hong Kong, and in Belgium, the FSMA, are involved in various capacity in the supervision of 95% of the financial markets all around the world. And we have also a lot of diversity. So it means that to have IOSCO on board is not a surprise when we speak about financial stability. And I had the pleasure to be elected in 2022 and re-elected more recently for a second term. I had three priorities, I would say, when I was elected in 2022. And all these priorities, there was a link with speed. Speed about, I would say, sustainable finance. It's not a surprise. John and Mary in the street were expecting a global framework, an international framework, and that's the case, because we were able in less than 1 year to endorse the standard as proposed by ISSB. And thanks to the call for action coming from the IOSCO, we have now, ladies and gentlemen, 56% of the global GDP, 56% of the global GDP, 43% of the global market capitalization, including the US, already having decided to switch, I would say, to the ISSB standard, and we have full interoperability with ESRS European standards. So speed was there, it's approved, now we are implementing up to the different jurisdictions to require, to allow, or to be informed by ISSB standard. The same about crypto. The kids of John and Mary in the street, I would say, are investing in Bitcoin and in other crypto assets, so there was a need for having a toolkit related to the supervision of cross-border crypto assets. That was the case also less than 1 year after my election. And last but not least, I would say NBFI, let us be clear, which is quite normal for you. But I have to tell you, when I had the pleasure not to arrive around the table of FSB, because I was there for many years when I had to replace my excellent predecessor, Ashley Alder, now the chair of the FCA and before the CEO of FSC Hong Kong, I would say the focus was not about NBFI, but about BFI, if I may say. It was about what happens in the Silicon Valley and not far from the EU in Switzerland. But my reaction was to say, look, it doesn't mean that we reduce the speed of that we stop I would say, the work stream about NBFI. No, my first comment for my colleague from the FSB was to see to which extent we could, together, achieve new objectives about how to better manage, I would say, the supervision of NBFI. And today, I have to tell you that I am proud to say that IOSCO has been able to achieve a lot in this area, especially the last few years. But of course, it was, in cooperation with FSB, and we have made a lot of progress in delivering policy solutions. Again, I don't have to recall you, you are specialists on this matter, and thanks for this prestigious audience, I would say. When the FSB was started as a replacement of the FSC after the subprime crisis at Pittsburgh Summit under Obama administration, there was some stress, let us be clear, from some IOSCO members. Do we need an umbrella? Do we need an umbrella? Is it not dangerous for, I would say, the visibility and the credibility of Basel Committee, EIS for insurance and pension funds supervisor, or even IOSCO? Frankly speaking, I have to say that I was always astonished by this kind of comment. But at the same time, I was maybe in the minority of the members of the IOSCO ecosystem. Because for me, having the capacity that someone else, much more objective than IOSCO chair, could, and it was the case with Makana, it was not the case with my colleague and friend Klaas Knut, to explain what we are doing. That's the best system. And that's what happened, because everybody knows the quality of the 4 pages sent every 6 months by Klaas Knut in his capacity of FSB's chair to the G20 leader. Excellent 4 pages. We know the quality, standing quality of FSB staff in Basel, saying what happens in the financial side. But if you have a look, the last 2 years, on the 4 pages, 2 were about IOSCO, about what we have been able to do for sustainable finance, about cross-border cooperation, about, I would say, supervision of crypto asset power, and of course, NBFI. For me, it's better to work with an excellent spokesman like Klaas Knut, especially if I don't have to pay for that. That was, I would say, the best system, and it works, I would say, this partnership. That's the reason why I would like, ladies and gentlemen, dear colleagues and friends, to focus my comment. Peter, I will try to stop in 10 minutes. I'm not sure that you believe me, but I will do my best, I would say. Let us try. 3 kind of comments. How to intensify international collaboration about NBFI. How to bolster trust in capital market and the link with NBFI, and of course, last but not least, partnership between IOSCO and FSB with 3 major work streams. Let us start with how to intensify international collaboration. Of course, this outcome of this work, IOSCO and our partnership with FSB, is the fruit, frankly speaking, of a real successful international collaboration between different authorities from across the globe, international organizations and standard setters, central banks, securities regulators, prudential regulators, etc. And each authority, ladies and gentlemen, brings, of course, its own expertise to the table. And this international collaboration between authorities with different mandates, I am used to say what the difference between a central banker and a member of our ecosystem. Most of the time, they have 1 page of statistic. Even if they don't read it, they have it. It's, of course, much more easy for a central banker, if I may, because I see many central bankers, because, of course, it's less fragmented. But we have to learn from that. And that was a learning curve for IOSCO, I remember, and we are going in the right direction, thanks also to the NBFI exercise. So it means that this international collaboration between authorities with different mandates is a key element to successfully addressing financial stability risk from NBFI. Just because NBFI is, of course, inherently diverse. And in addition, financial intermediation does not stop at the borders, nor do its risk. None of us, let us be clear, can address the financial stability risk of NBFI on their own. We need each other. And to address NBFI risk, we need to intensify international cooperation, even in a more challenging geopolitical context. And the same is true at national level. Belgium is an excellent example of national cooperation in this regard. Of course, everybody knows that the Kingdom of Belgium is not a giant country, but I have to stress that the FSMA, we are working, as you know, maybe in a twin peak models, FSMA and the Central Bank of Belgium, the NBB. The FSMA and the NBB cooperate very well on NBFI matters. Both institutions are committed to monitor and address financial stability risk from NBFI. And I have the pleasure to tell you that last week we published our sixth joint report on the monitoring of asset management and NBFI as part of this comment. Second main accent, if my comment, is how to bolster trust in capital market. Everybody is speaking, rightly, after the publication of Draghi and Letta report about the funding of European SMEs, growth company, and infrastructure through a capital market. And of course, the funding is high on today's political agenda. And to ensure that funding through capital market is stable, it is of vital importance that NBFI is resilient. And we cannot take financial stability and NBFI resilience for granted. Do I have to stress again, to recall that it has been illustrated by a number of incidents and events these last few years. Of course, the failure of Archegos, the stress episode in the UK gilt market, the commodities market shock, and of course, the March 2020 market turmoil. And I stressed earlier, reducing systemic risk is one of the three objectives of IOSCO principle of securities regulation. And this objective becomes even more important as more retail investors participate in capital market. An increased retail investor participation can be achieved only when investors are sufficiently confident about the stability of financial market. Recent measure and new proposal seek to reinforce resilience for NBFI and thereby bolster the trust of investors. Let me be clear, that's very important in order to avoid any misunderstanding. There is no conflict between the objective of enhancing NBFI resilience and the objective of increasing funding through capital market. Addressing financial stability risk for NBFI is a prerequisite to achieve CMU objective. And now let us shift to the last part of my comment, the partnership between IOSCO and the FSB. Over the past few years, IOSCO has been committed to strengthen its partnership with the FSB and to deliver policy proposals to address vulnerabilities from NBFI. Starting point was, of course, the March 2020 market turmoil market, and it was a turning point in this regard. It was the catalyst for a really ambitious working program focused on aspects related to liquidity and the use of leverage by NBFI. That's the reason why we decided to innovate with a real partnership between FSB and IOSCO. The content is the most important aspect, but the architecture, I think, is not to underestimate. That was the first time, ladies and gentlemen, the first time in FSB history, and this is also a remark for Basel Committee in EIS, that there was a real partnership on equal footing between FSB and one of the members of FSB, in this case IOSCO, and that's the reason why we decided to launch a common liquidity risk management in open-ended funds work stream. It was co-chaired by one representative of the IOSCO ecosystem, Christina Choi, excellent representative of the IOSCO ecosystem, and at the time, Sharon Donoghue was working at the time, he's now a colleague of Francesco at the ECB, another excellent representative of, I would say, the ecosystem of the central bank. And it was indeed a key policy deliverable because we had to review at both levels. FSB recommendation 2017, IOSCO toolkit for liquidity management tool of open-ended funds 2018. And the fact that we were able to launch together this new deliverables was a signal, I think, to the market, but also to the political decision maker in order to strengthen liquidity risk management in open-ended funds. And just over 1 year ago, the FSB and IOSCO jointly published 2 policy documents that aim to achieve this goal. Is it normal? No, it's not normal. I'm not sure that so many people in this room thought that we were able, first of all, to find a consensus. You know the debate about the kind of liquidity management tool that we can have in some jurisdiction. The fact that we were able to tackle together 2 different consultations, the fact that we were able to publish the same day, the fact that FSB, Klaas Knot, John Schiller, and myself were able to organize the same day, the same hour, the same minute, a press conference about the release of report was, I would say, du jamais vu. It was the first time in history. So it means that it works. And also the reaction of the industry was, I think that I may say, very positive. As far as IOSCO is concerned, we especially encourage greater use and consistency in the use of anti-dilution LMT. Anti-dilution LMT are, of course, a crucial element of a policy framework to address liquidity mismatch in funds. And the enhanced use of anti-dilution LMT aims to both strengthen investor protection and to safeguard financial stability. The use of anti-dilution LMT mitigates investor dilution and thereby also the potential first mover advantage arising from liquidity mismatch. And besides, after that, in November last year, 2024, we published a consultation report seeking feedback on a proposal to update its liquidity risk management recommendation for collective investment scheme. And this, the objective of this update is to further operationalize the revised FSB recommendation and builds on lessons learned from market events that took place after the initial publication of the IOSCO recommendation in 2018. The proposed update, therefore, incorporates, among others, a categorization approach for open-ended funds based on the liquidity of the asset. It also encouraged the implementation of a broad set of liquidity management measures. Frankly speaking, I think that I'm not too much exaggerating when I say it was a flying start for this new kind of partnership on equal footing between FSB and IOSCO. And that's the reason why I would like to invite you to read our consultation report and provide us with feedback, deadline 11 February. Second work stream, NBFI leverage. Again, the same architecture, co-chaired by, again, by 2 ladies, Sarah Pritchard from the UK FCA and Cornelia Althausen from the ECB, again, co-chaired, 1 representative of the ecosystem of central banker / prudential regulator and finance. For you, it's maybe not so important from a conceptual point of view, right? But I think for the quality and for the feasibility of the exercise, it was important to have the co-chairmanship in order to be able to take on board all the different aspects of the work. And that's the reason why last year we turned out our focus to leverage. In December, the FSB, with the support of IOSCO, published a proposal with policy recommendation that could contribute to improve our capacity to monitor and mitigate financial stability risk from leverage and NBFI. I don't have to tell you it's a difficult agenda. Activity-based versus entity-based was the involvement of the different kind of people working with leverage, leverage provider people benefiting from leverage. It has to be proportionate, I would say, in order to be powerful. And our main concern that emerged in recent years is the extent to which leverage is hidden and the consequences this may have on financial stability. That's the reason why the proposed recommendation, ladies and gentlemen, address this concern by proposing a package of recommendations, including, first, a framework for authorities to identify and monitor vulnerabilities from NBFI using a toolkit of metrics, and second, a review of public and private disclosure. And it's important from this point of view that leverage provider receives sufficient information from an NBFI entity to enable a sound credit risk management. Let us be clear, that's one of the touchy aspects of the work. And this includes, for instance, information on the aggregated exposure managed by the NBFI entity. Such information should allow leverage provider to assess risk from concentrated and large exposure, such as those we have seen in the case of Archegos. The consultation report also proposed recommendations to address financial stability risk from NBFI. And this includes a review of activity-based and entity-based measure. The combination of activity-based measure and entity-based measure is extremely important. As I mentioned earlier, NBFI is very, very diverse. There is no one-size-fits-all approach. It would be ridiculous to think that. Activity-based measure can be used to target highly leveraged strategies employed by NBFI entities subject to different regulatory framework or even outside the regulatory perimeters. Example, of course, of activity-based measure are minimum haircut, enhanced margin requirement, and central clearing mandates. This report, ladies and gentlemen, is recommending a range of policy tools that authorities can choose from to address leverage risk in their jurisdiction. That's important. It's a global approach, but we are able to take into account national specificities. And the inherent diversity within NBFI and across jurisdiction ask for a tailored approach. Who had expected that? Maybe not necessarily everyone some years ago. And the precise package of measures need to be proportionate to the nature of risk posed by NBFI. And to assist authorities in the selection, design, and calibration of policy measures, the report contains a set of guiding principles. In addition, this report also contains a specific recommendation to address inconsistency across different types of NBFI entities by adopting the famous principle, of course, of same risk, same regulatory treatment. This approach ensures that the outcome will be both tailored and consistent across jurisdiction. I would also like to come back to a point I made at the beginning of my intervention. None of us can address financial stability risk on their own. Risk from NBFI leverage may emerge from other jurisdictions. Likewise, NBFI leverage may impact market in other jurisdictions. We therefore need to enhance cross-border cooperation, coordination, and the place to be is, of course, Basel and Madrid, FSB and IOSCO, but also EIS and Basel Committee, which are also located in Basel. Consultation, ladies and gentlemen, is open until 28th of February. Last but not least, and I will close my comment then with this last comment, NBFI data challenges. Of course, for many of you, because I see many colleagues and former colleagues from the central bank, of course you would say, not so easy data challenge. Most of the time, it's outside the remit of the overall majority of national supervisors. Most of the time, we don't have the legal basis. My professional secrecy, and it's the case for many other European colleagues, is enacted in, I would say, at the European level, in criminal law provision. And the reason for that is not to protect the bank, it's just to be able to allow to ask more information for the bank. But the price to pay, if I may call it like that, is to accept, I would say, the professional secrecy. If I am not complying with that, ladies and gentlemen, it means for me and to all my colleagues at European level, the jail. So we have to find solution. And from this point of view, I think that we need to accept the data challenges, but from a proportionate and realistic point of view. And I'm used to saying we are richer than we think. Many information is already available, not only in Europe, not only in the Eurozone, but also in the US, also in Asia. We are richer than we expect because there is a lot of information for that. And that's the reason why we decide at FSB level to launch a new task force about that. And again, I think that it's a private secret, a public secret, sorry. Again, IOSCO will be involved because we have a MOU. We have a MOU which means 6,000 times a year exchange about many information relating to market accident, market development, market abuse, inside information. We also have the capacity, but it has to be fine-tuned, it has to be precise in order to avoid, I would say, any problem about professional secrecy. And today, I think that regulators have made the transition to data-driven supervision. But it means that to be able to implement this, we need sufficiently granular and qualitative data, and we need to continuously optimize our data processing capacity. I'm used also to saying every week, more or less, to the industry, look, if you refuse the debate about the challenges, that's the best way for brutal macro-proof measure. If you don't have data, you are coming with brutal political measure. Is it what we are expecting? I don't think so. First of all, we know to understand our market, and that's the reason why to accept on a proportionate, rigorous, professional way to accept the debate of the data can be useful. Because this also holds true with respect to financial stability of NBFI, and IOSCO stand ready to work on this together with FSB. Just for information, we need to think about the fact that IOSCO and FSB don't exist from a legal point of view. ECB exists, SSM exists. If I am asking an information as IOSCO chair, I won't have a measure. If I'm asking information as chair of FSMA in Belgium, it means that in compliance with IOSCO MMOU or ESMA or EOPA or EBA or even ESRB aspect, because we are also a member of the SSM for some aspect, I would say, I can receive an answer. So it's also a real legal challenge, but it doesn't mean that there is no solution. But of course, it means that we need to be proportionate and cautious. It doesn't not mean also that we are not aware that market participants are already subject to a high reporting burden today. Let us be clear. And I believe that we indeed need to look into ways to reduce this burden. And I believe that we indeed need to look into ways to reduce this burden. What does it mean? It means, for instance, that we could do, for example, by developing more uniform templates across reporting regime. I think that was a comment made during the panel about that. It's not so difficult for me. Or by exploring the possibility of collecting more raw granular data instead of calculated and processed data. Overcoming data challenges does not equal more reporting by definition. Again, we are richer than we think and we expect. Yet, this does not mean that new reporting obligations that would enhance the monitoring of financial stability risk are ruled out either. In any case, a reduction of the reporting burden is likely to be a net reduction instead of a blunt cutback. Ladies and gentlemen, it will be my last comment, more or less on time. To achieve CMU goals, we need to reduce both the reporting burden and financial stability risk. Thanks for your attention.
Gentlemen, I hope you all enjoyed the coffee break and had the opportunity to connect a bit with fellow attendees. As we reconvene in this room, energized by hopefully a bit of a caffeine boost, we are set to continue the agenda of today's conference. It's time for a highlight of our program, an incisive fireside chat with two distinguished experts in the field. We are very honored to welcome on stage Mr. Claudio Borio, who until recently led the Monetary and Economic Department at the Bank of International Settlements. His insights in the financial cycle and monetary economics have been seminal to our current understanding of financial stability. Joining him is Mr. Peter Praat, former chief economist of the ECB, and also honorary member of Suerf. His extensive knowledge of the Eurozone economic challenges has been instrumental in guiding monetary policy and ensuring financial stability. Together, they will now explore the advancements of non-banking financial institutions and the implication for regulation, supervision, and monetary policy. Please join me in giving a warm welcome to Peter Praat and Claudio Borio.
So hi Claudio. Now I'm supposed to have this conversation with you. It's an immense pleasure. You know that I've not been able to come to your farewell at the BIS because there was another conference and I had a commitment in Frankfurt. So I'm very grateful to Suerf to organize this rencontre, this conversation with you. You know, I ask you, Claudio, the first time we met was in '87. And that was a Suerf event, probably in Vienna. We don't remember very well, but it probably in Vienna.
We don't remember the year either very well, but
well,
it was a long time ago.
You entered the BIS in '87, and at that time I entered the Générale de Banque in '87, also at the time of the crash. And since all these years up to now, there were many actually financial stability events. And I mean, the list is so big that maybe it's going to come in our discussion. But Claudio, I wanted to, again, first to tell you what I think about you when I think about you. It reminds me, Alexander Lamfalussy, Ivo Maas is here, the historian of Alexander. And I was in a plane with Alexander and we discussed, you know, the BIS. And he insisted so much to have a strong research, independent research in the BIS. And you with Bill White, you remember Bill White? I still see Bill. You are the examples. You know, for me, you are really the sort of children of Alexander Lamfalussy. And I never forgot that, you know. And in my experience, you know, also at the ECB, because I had a team of economists, 200 economists, for me it was, you know, to try to unleash, you know, independence and creativity, which was not the tradition really in central banking. And but at the same time, you know, as policymakers, you have to control creativity. Any regrets? You know, I think you always said what you thought, no?
Oh, yeah. Well, first of all, let me say that in a way, I mean, given that you're talking about Alexander and we are here in Belgium, I also feel a little bit like I owe him quite a lot. In fact, just to give you an example, going precisely to what you said, I remember that in, I think it was 92, 93, I had written a chapter of the BAS annual economic report that was already talking about financial cycles in a way or other. And the second part of the chapter was about how to manage crises, banking crisis. And it was, at the time, again, talking about can you say what you think, it was rather daring because it was 92, 93, remember. And in the crisis management section, I added and I discussed Japan. But at the time, the only thing that had actually happened in Japan was the so-called JUSENs, which were sort of non-bank financial intermediaries, talking about another topic of the day that had actually run into trouble. And I remember Alexander calling me in his office. He was the general manager at the time, and sort of saying, oh, I read the chapter, I think this is great. I mean, this is precisely the kind of stuff that we need to do. And it was also pretty much ready to defend you because, in fact, because of that chapter, I think so many years have gone past that we can say it, you know, the central bank actually complained about it and sent a letter saying you should not be discussing Japan. I mean, what's going on? I mean, Japan, there's not much happening. Everything is fine. And he just basically said, ignore it and go on. And so that kind of spirit, first of all, the DNA of, you know, the financial side, the implications for the real economy and therefore for central banking more generally, and the willingness or to go out and to say things that might not be really that, just be the minimum common denominator within the central banking community. That was really something that Lamfalussy injected me from the very first day, and I think that that has been the DNA of the institution, thanks to him as well. And then, of course, Andrew Crockett and Bill White, they continued in the same tradition.
And it was not easy for those who are not familiar in the BIS environment. Central bankers meet, supervisors also meet in different settings in the BIS, but you remember we were together in the CGFS, the Committee on the Global Financial System. Bill White was the chief economist at that time. And you remember how difficult it was in the years before the great financial crisis, how difficult it was to express, opinions which were not in the mainstream of central bankers. Bill White was called Mr. Doom, and not only for a few months of time, but months after months, each meeting people were joking until the crisis came in 2007. So being independent is one thing, but also resisting to that sort of pressure is immense. So how do you?
Well, first of all, you need a lot of stamina to sort of take it, because that means, in a way, a lot of what happened at the time was like going through a desert in many respects. But in fact, the whole thing started publicly in the public domain with a speech that Andrew gave here in Suerf in 2000. And that was on the relationship between monetary and financial stability. There was a second speech which was later in the year he gave at the Basel Committee meeting that was on the interaction, the macroprudential aspects of regulation and supervision. But effectively, that speech that Andrew gave, which effectively was already laying out the key aspects of the views and the key aspects of the research agenda, was what gave us the necessary protection, if you like, to actually carry out that research agenda without worrying too much about what central banks might
now,
say.
In this conference, we deal with non-bank financial institutions, and my reaction to that, it's a very heterogeneous group of institutions, and I think the next conference could be, banks and non-bank financial institutions and the big tech, and the other players, because that's the big issue now coming. But if you look at the landscape, you remember what we were trying to do, because I was also part of that sort of setting, is to address the financial cycle in two dimensions. The time dimension, so financial cycles, and you worked a lot on this. And the other was the what we called the cross-section dimension. So on the two issues, and years after, what is your sort of perception today? I mean, is on the ecosystem, the financial ecosystem, I mean, would you say it's safer than before? We try to address excessive leverage, excessive liquidity risks, reduce interconnectedness, also addressing the too big to fail, mastering the financial cycle. I mean, when you look at the objectives we had after the global financial crisis, the Philadelphia, G7, I think, at that time. Do you think the system is safer now, or you say it's as dangerous as before, but differently dangerous? Or more dangerous?
Okay, so that's a very big question. But let me start by saying that yes, indeed, the key aspect of systemic risk that the BIS has been emphasizing a long time, which is to distinguish the time dimension from the cross-sectional dimension. Now, in the time dimension, where pro-cyclicality comes in, the self-reinforcing feedback between availability of financing, credit, liquidity, and availability of financing, credit, liquidity, risk-taking, which generates booms and then followed by busts. That's one aspect. The cross-sectional has to do with the distribution of risk within the overall financial system and the level of risk at a point in time. I would say that when it comes to the procyclicality, that the financial, or if you like, the time dimension, I mean, the financial cycle, which tends, as we have emphasized, longer than the way that economists typically think of the business cycle, is one and the most important aspect, and that at least until recently, which is basically what we saw during the global or the great financial crisis. That's one aspect. But at the level of the financial system, financial markets, there are also sort of higher cycles, if you like, more frequent cycles. that have to do with this risk-taking waves and risk retrenchment waves that are not really at this level of the longer-term financial cycle that has to do with credit and property prices in particular, but can be quite disruptive as well. And the other thing that I think it's important to mention today, it might not have been that important to mention it in the early 2000s and so on, is that there is a huge, if I were to look ahead, quite apart from private sources of systemic risk, one of my biggest concerns these days is public sector debt and the risk coming from the public sector. And those are not risks that follow standard cycles. If anything, the problem there is the gradual ratcheting up of fiscal positions over different business and financial cycles. And looking ahead, I think that that is going to be the biggest longer-term problem that the economies worldwide will be facing. So when you tell me, is the financial system more or less better or worse off than it was in the past, I would say that we have done quite a bit of work to deal with the financial cycle, except that we have left a big important element outside, which is, and I guess we'll come back to that, which is monetary policy. I think in the cross-section, we have done significant work in terms of understanding the correlation of exposures within the financial system. But I think that the biggest risk going forward is going to be the public sector.
It's difficult to tell because when you ask yourself the simple question about leverage, how leveraged is the system today? On one hand, you would say the banks are lesser leveraged than before, the banks themselves, but their clients are not necessarily lesser leveraged. And the Archegos case that was, the example which was given by Jean-Paul Servet, I mean, it's a frightening example. Now you say, okay, all these stories ended well, but they also ended well because central bank liquidity injections and because massive interventions of authorities in general. And that's in the recent financial stability cases that we have seen. You had really the authorities intervene very quickly. In the past, when you had that, you had a very strong reaction, regulatory reaction. Jean-Paul has told us about IOSCO and FSB initiatives. We will see what happens. If you give my personal opinion, and especially given what is happening in the US, and when I read what the successors of the chair of the FDIC is saying in his speeches, he's a more Trump guy. And if you see what's happening in the Fed, also, and the UK following, knowing where the wind is going to blow, I think the concerns are, to my view, extremely high. And you had public finance. So let's...
Well, I mean...
So I'm more worried than before.
There are many different elements in what you've just said. So let me take a step back. When I say that the biggest risks, the most important threat to macroeconomic and financial stability longer term is coming from the public sector, it's just to remind people that a lot of the work that we were doing in the context of macroprudential frameworks and the like, as you've mentioned, was in the context of these financial cycles and so on. But we should not forget that there is another big source of systemic risk in the economy, and this is what we're going to be facing. We haven't dealt with at all. And I'm really very concerned about the situation with fiscal policy around the world. So that's one point. If we leave that aside and we go back to the financial sector, more specifically, when macroprudential regulation was developed, or when, if you like, when the macroprudential approach to regulation and supervision was developed, it was basically the banking sector that was the focus of the analysis. And for obvious reasons, that was where the things were most urgent. And that we should never forget that the key difference between the banking sector and other sectors is that banks issue means of payment. And that's really where the dividing line is between that sector and the rest of the economy. But both sectors take leverage, both sectors take financial maturity and liquidity mismatches and so on, the banking and the non-bank financial sector, which is extremely heterogeneous, by the way, and this is something that came up before today. So I think a lot of progress has been done in the context within the banking sector, although I'm a little bit concerned about sometimes the different signals that one gets from accounting measures of solidity and market measures of solidity. I think we need to reflect on that. But of course, part of to some extent, the big growth in the non-bank financial sector was an intended result of what was being done. I think what was not properly intended was the fact that regulation and supervision within that sector, despite what we heard before today, I think hasn't really kept up. And I think that there is still some work to do in that area.
One of the, I found very interesting points you made in some of your publication is the development of collateralized funding. Is it safer or not safer? A priori, it's safer, but it changes the incentive system. Can you come back to that?
So in a piece that we wrote with colleagues recently, we were just struck by the fact that there is, what you might call, a little bit of a fallacy of composition when it comes to the extensive use.
Fallacy of composition.
The extensive, sorry about this. I mean, maybe I should have put the other thing on. The extensive use of collateral in the financial system. Collateral is a way of dealing on a bilateral, individual basis with counterparty risk, right? But it has broader systemic implications that we should keep very much in mind. It may actually increase, going back to, you asked the question about leverage, the overall amount of leverage in the system. Because the whole point about collateral is that A, you don't need to monitor to screen your counterparty that well, because all you look at is the value of collateral. And B, you don't need to monitor your counterparty that well, because you have the safety, quote unquote, of the collateral. So the obvious point is that collateral is there to allow you to lend more than you would otherwise have lent. So at the level of the system as a whole, ex ante, the extensive use of collateral, which is also being promoted by regulation, means that it's likely that the overall level of leverage in the system is going to be greater. So that's one point. The second point is the other thing that I think came out, is better known, better understood, is the fact that, of course, the use of collateral shifts risk from pure credit risk to liquidity risk. Counterparty credit risk to liquidity risk. And of course, liquidity risk exposed, because the whole idea is that you're going to be liquidating the collateral when your counterparty fails. And liquidity risk ex ante, because of all the margin calls and so on that are necessary in order for you to manage that counterparty credit risk. So I think that the systemic implications of collateral is something that we haven't fully appreciated. And the simple equation, more collateral, a safer financial system, I don't think is quite right.
I think that's a very important point. And it shows the interrelation between bank funding liquidity and market liquidity of banks. And so, which was in the past, we had a bigger separation than.
Yeah, but I think that separation, at least also within the official community. I mean, I remember in the early 2000s.
Well, with structured finance, we also had this.
Yeah, but I remember that in the early 2000s, when I was reading the academic literature on liquidity, it was all about asymmetric information about the value of the asset and so on. But people like me, who was working for the CGFS and so on, were thinking of collateral in a very, very different way. It was precisely in terms of the interaction between funding liquidity and market liquidity as, if you like, interfaced by risk management in general. So really what liquidity is about, funding liquidity, market liquidity and risk management are effectively very, very closely tied. And that was already obvious, for example, when we had LTCM, and indeed one of the reports of the CGFS, which dealt with that issue, called it like a global margin call. And going back to 1987, when I joined the first joined the BIS, I joined in October 87, and the first task that I was assigned was to write about a chapter on the stock market crash. And there again, you already saw at the time, it was about portfolio insurance, it was about program trading, it had nothing to do with the type of stuff that one found in the academic literature.
If we go to central banking, you made also a very important point, I thought, about the natural rate of interest, the endogeneity of the natural rate of interest, which is sort of revolution, because I think many central bankers would disagree with your points there.
Yes.
And I think it has serious monetary policy implications, of course, if you follow. Could you maybe explain a little bit the idea, because that's very, I think it's really you, right? It comes from you, that idea. And it's quite important. The second aspect of central banking is the central banking sort of lender of last resort to markets, market maker of last resort, or even more than that. So the sort of central bank liquidity in markets in general. So there are two topics, I think, with central banking. One is monetary policy, and the other is
if we talk
provision.
about the interest, if we talk about the interest rate as opposed to lender of last resort, market maker of last resort type of issues, I think the link between that and what we've just been discussing before has to do, well, actually, there are two links. One is that the interest rate sets what you might call the universal price of leverage within a particular currency area, and that's critical. I think if I look at the impact that central banks have, if you have to tell me, do central banks have a bigger impact on the financial system and financial stability issues from this perspective than on inflation, I would almost go as far as saying that they do, in the sense that to the extent that they have an impact on inflation, leaving aside inflation expectations, but the mechanical transmission mechanism is precisely by influencing what's happening in the financial system, and influencing hugely what happens in the financial system by setting the universal price of leverage. Now, if, as much of the literature basically assumes, the real interest rate is basically determined by factors that have nothing to do, the equilibrium interest, real interest rate, have nothing to do with factors that are related to monetary policy, but real factors, then you feel that you're very much a spectator in the game, that you're just having to respond to forces that are beyond your control. Now, one of the arguments of some of the work that we have done is that, in fact, even over longer horizons, to the extent, for example, that monetary policy has an impact on the financial cycle, and the financial cycle has a significant impact on the macroeconomy, which it does, particularly through crisis and so on, then the real interest, or the equilibrium, quote unquote, real interest rate that you take as given, as exogenous at a particular point in time, may in fact be to a considerable extent the result of your past policies. By keeping interest rates too low, you sort of you allow the buildup of these problems. These problems then hit the macroeconomy, hit the financial system, and then of course, once you have a financial, what you might call a financial recession, which is the result of too much leverage, which is the result of the misallocation of capital, you will have to reduce interest rates and keep them low for a considerable extent in order to get the economy back into equilibrium. But it doesn't mean that that rate that you consider to be the equilibrium rate at a particular point in time is completely exogenous to the central bank. It's actually to do with, to some extent, not only, to what the central banks have done in the past. That's from, if you like, a conceptual point of view. There are other aspects that one could mention. But also from an empirical perspective, if you actually look at the relationship between real interest rates and the usual suspects, productivity growth and demographics and the like, from a very, very long-term perspective, going back to the previous century, you actually don't see a systematic relation. You do, the only time where you see it is since the 1980s, when everything seemed to be moving in the same direction, and we were coming out of the Volcker disinflation. But if you go further back, you don't quite see this tight relationship. But actually, you do see a relationship between the level of real interest rates and monetary policy regimes. So I think that, and for a number of reasons that I discussed in the work, I think that that link is something that we have underappreciated. And then it goes back to the point that I was making before. I think that while we have made considerable progress on the macroprudential side when it comes to regulation and supervision, at least for banks, I haven't seen the same kind of shift in the intellectual framing of the questions when it comes to monetary policy.
Because that was your last paper, I think, at the BIS, important paper was on, monetary policy regime. Once we go back to the 2%, sort of inflation, and how should you conduct monetary policy?
Yeah, I mean, the argument there is that we should think of inflation, and there is strong empirical evidence for that, as, if you like, the way we describe it to simplify is a two-regime view of inflation. And the key point there is to say that the behavior of inflation at a very, very low level, when it's roughly 2, 3, in that region or below, is quite different from the behavior of inflation when it is a higher level. And it exhibits strong self-stabilizing properties, because what we measure as inflation is in fact simply largely the result of a myriad of idiosyncratic price changes that take place that tend to offset each other and don't have much persistence. Now, from an economic perspective, the reason why that is also likely to be the case is because when inflation is very low, people hardly pay any attention to it. And if they don't pay any attention to it, it cannot be an important factor driving their behavior, which, by the way, was the definition of price stability of people like Volcker and then later Greenspan. So to the extent that inflation, when it is in a low inflation regime, is self-stabilizing, which it is not in a higher inflation regime, then also some of these big concerns about self-destabilizing deflation and the like tend to be overblown. And again, if you look at the historical evidence, that's another example. So to the extent that one of the big reasons to do so much and for so long when inflation was below the inflation target.
Yeah, that's where we diverge sometimes in our discussions in Basel. Well, I mean, I take your point. I mean, I think it's an important point, and it makes me think about all this. But the problem we had at that time, because you tend to underestimate the deflationary risk, in the period, post-global financial crisis. So you say you overdid it, actually, with the non-conventional measures, the negative rates, QE and all that. I think I would agree with you that probably all these non-conventional were too long. When they were designed, it was not expected to be lasting for years and years. So with all, potential and maybe real consequences on the economy and financial markets. So I would agree with that. But actually, the big problem was the lack of, response to the banking system, the very slow restructuring of the banking system for years and years, and how to address the sovereign debt crisis. And in a certain way, the central bank was, in a way, cornered because the other authorities were reacting relatively slowly. And then you went into that sort of, non-conventional policies for years and years. So, but you were not directly in policy, and I know you take this remark without problem. When you have to when you are in policy making, of course, at some point you have to do something, because I remember, if you have to decide or not, to object to emergency lending from the Greek central bank, to the banking system in Greece, it's not so easy to say no. And it's more comfortable when you're in the BIS or in the IMF than if you are a decision making. And so that's the whole relationship, between monetary policy and the other authorities. So your basic conclusion was, I guess, that central bankers have been too weak. They should have been tougher. And saying no was maybe more difficult than saying yes.
I'm not going into the specific issue of Greece
I hope
and
you
whatever.
Good, I prefer that.
I'm talking about the more general thing that is not just
no,
Europe.
but at that time, Claudio, at that time, I remember in our conversations at lunch, after the CGFS, the committee, very often we were sitting together and we discussed that briefly, of course. And I say, oh, yes, I tend to agree with your points, but it's when you're face that sort of situation, what do you do? And so, but you would understand why central banks did what they did, no?
Look, I mean, one is talking about a question of degree. It's not a question of qualitatively. It's, as I said, and I said it very clearly, if you have a balance sheet recession, the response has to be from the central bank, I reduce interest rates in order to somehow help the deleveraging process and so on and so forth. That's obvious. In fact, I was saying
that's a very important point. That's a very important point.
That's one of the mechanisms through which you
I
actually
fully agree.
get
Yes, yes.
But to me, the issue is not so much about what you do when you have the crisis, but what you after the economy gets going and so on and so forth. I felt that very often the idea that inflation was 1.5 as opposed to being 2 was perceived as being a big problem. And my argument, based on the evidence that I have seen, is that, well, no, actually you are within what is called a low inflation regime. So you should not try necessarily to do everything that it takes to get inflation from 1.7 to 2% or whatever, because you are in a regime in which inflation is so low that from the point of view of households, from the point of view of workers that are setting wages and the like, it's not an important factor in your decision making. So effectively you are within the region of price stability. And the economy is not going to tank because of that. And indeed, the economy was doing pretty well for all the way, for quite a bit of that period.
On maybe on fiscal policy, to go back to that, you think there is some creeping fiscal dominance?
Clearly, if you have a situation in which fiscal policy is out of kilter, going back to the choices that central banks have, you're restricting the choice set for central banks, and you're making the trade-offs much, much harder for them. And I think what we have seen over time is that both monetary and fiscal policy had been running out of room for policy maneuver. And what's now happening is that the fiscal position is very, very sensitive to higher interest rates, which one way or the other is going to make life tougher for central banks.
I agree. I mean, we have seen in the US, since they cut the rates, 100 basis points, long-term rates have increased by 100 basis points. So, and that's the term premium essentially. It's not so much the future short-term rates expectations. And so the question, as we have seen for the dash for cash, but this was really in a special situation, which was mentioned by Jean-Paul, is where the central bank intervened for huge amount on its balance sheet in a specific financial stability point. The question, of course, if you get a more sustained, increase of term premia because of what you say, what will be the reaction of the central bank and what will be the relation with the Treasury in general? The Treasury has issued a lot of short-term bonds recently to avoid the pressure on the long-term bonds, also in the context of QT, of quantitative tightening. So there's a lot of issues around public debt. It's real now. And personally, what I think since years and years, and that's a question now to you, I think the tail risk, when you look at the tail risk on markets, the perception of markets that tail risk will be taken over by the central bank, by the balance sheet of even temporarily, but by the central bank, I think that's very present in the markets today because the central banks intervened strongly. You think there is moral hazard in the system? It started with 87 with the Greenspan's put and then many other examples.
I would say that it's what we're seeing now, it's beyond just purely moral hazard, and it's not just a question, or
it's
even
beyond pure moral hazard.
And even primarily a question of central banks. And when it comes to, for example, the one of the reasons why I'm particularly concerned about the outlook for fiscal policy in general is that the demands on the authorities are growing, and also the public, following the GFC, following COVID and so on, has come to expect a lot from fiscal authorities. So becoming like the if you like, the saviors of first resort. And this is going to make, quite apart from the demands that are growing for the transition, for defense, and so on, this is going to make it very, very hard for policymakers to respond. And on the monetary policy side, we have seen something broadly similar, in the sense that central banks have been forced to come in more and more often, and it's at some point and they have found it very difficult to exit. I mean, one of the big changes that has taken place from over the last 20 years or so is, as we know, two big shifts. One is from lender of last resort to market maker, or if you like, buyer of last resort. That's one big shift. And the other big shift, which is related to this, is the blurring of the line between monetary and fiscal policy as a result of the fact that you're using the balance, actively using the central bank balance sheet in order to alter, you have been using, in order to alter financial conditions. And this has been exposing the central bank to greater risks at a point in time, because if you buy assets, then you're actually taking the whole risk on your portfolio. It's exposed it to more risk over time, because exit is much harder from a balance sheet than it is from just adjusting interest rates. And the fact that a lot of the risk that we have seen has come also from the non-bank financial sector means that the central bank has less control over the other side, the regulation of the sector itself. So it feels it's necessarily more exposed than it was in the past. And there is a kind of catch-22 situation in all of this. And I think this is something that the FSB and other bodies are contending with. On the one hand, the fact that the central banks say this sector as a whole can be systemic, a source of systemic risk. And because of that, they have come in to provide liquidity and sort of stabilize the situation. And on the other hand, I would say the typical view of the securities regulators is, well, nothing much happened, you see, everything is still stable. So it is indeed a catch-22 situation. And to me, this is going to be very, very difficult to resolve, and is one of the reasons why, despite what we heard before, progress within the FSB has been so difficult.
And I agree with what you say. My concern, when you look at the pricing of tail risk, it's very low. And you see the exuberance on markets, and the tails are underpriced in spite of all what we see. The IMF has flagged this issue also very strongly in their financial stability report. So I think that's an issue. We have the governor here of the National Bank. He's going to intervene. Ernest, I think it's about time to close. Just here a point, Pierre. When the ECB came, but in the context of the COVID, ensuring the proper transmission of monetary policy to all jurisdictions of the euro area, I thought that was very strong. Something in my time would have problems in doing that, in saying that, but ensuring the proper transmission to all jurisdictions, that's quite strong actually. And that's, of course, it was in the COVID context, but I think it's good to reflect on this, because I think really in the markets the tail risks are underestimated, underpriced in general, and basically because of the expectation of central bank liquidity injections in markets or in banks, as we have seen with SVB and other cases recently. So I think that's maybe as old-timers, thanks for joining me. I think that's our preoccupation, yes. Thank you, Claudio. Thank you very much.
And purpose of today's event, the awarding of the Suerf honorary membership to Claudio Borio. I believe I have known Claudio Borio's name, not yourself, but just your name, as an important brain and voice at the BIS ever since I started my professional career as a central bank economist. This is not implausible, since when I started at the Austrian Central Bank in 1988, Claudio had already started at the BIS a year earlier. So when as a young economist at the ÖMB, I had the opportunity to spend 4 weeks at the BIS, I also came across you and I admired your acute knowledge back then already of international financial and banking statistics. What I did not know back then was that you also had a life before the BIS. And indeed, you have. So from 1984 to 1987, you worked as economist at the OECD, in the country studies branch of the Economic and Statistics Department. Prior to that, you were a lecturer and research fellow at Oxford University, from which you also hold a doctorate, a master, and a bachelor in economics and politics, philosophy, and economics, respectively. As the years and decades passed, our paths crossed many times, also in the context of spring economists meetings and so on. And I watched with interest and admiration your development, both in terms of the research areas that you covered, and we just got a little appetizers from this interesting exchange, and in terms of your professional career at the BIS. Indeed, over the 37 years since 1987, you have held many different positions at the BIS in the Monetary and Economic Department, including Deputy Head of the Monetary and Economic Department, Director of Research and Statistics, Head of the Secretariat of the Committee on the Global Financial System and the Gold and Foreign Exchange Committee, which is now the Markets Committee. All of us know and appreciate your leadership over more than a decade as head of the Monetary and Economic Department of the BIS from November 2013 until December 2024. During this time, and indeed already long before this, you were an astute observer and analyst of global economic developments in the spheres of macroeconomics, financial markets and banks, monetary policy, financial stability, and central banking in general. Basically all of the themes we have touched upon briefly in your dialogue now. Throughout the years and decades, you provided in-depth research based on a combination of sound theoretical foundations, a thorough knowledge of the state of the literature, you just referred to it, and empirical findings, where your deep familiarity with global economic and financial statistics helped. What is more, in your work, you not only added substantially to the existing literature, but often you initiated and defined key themes and set whole new research agendas for central bankers and for researchers worldwide in several fields. What I find particularly impressive is that you never shied away from swimming against the mainstream. Not surprisingly, this yielded you both praise and sometimes also controversial discussions, to put it in polite terms. It is this independence of thinking, combined with careful and meticulous execution of the underlying analysis and research, that I find particularly admirable and worth our praise. Besides your work as a researcher and manager, you were also deeply involved in committee work, in global conferences. You were really a sought-after speaker, very difficult to get Claudio as a speaker, and also in associations such as Suerf, where you were a member of the Council of Management between 1997 and 2007. Throughout the years, also when no longer in Suerf's Council of Management, you always took care that the BIS was well represented in Suerf with excellent experts and thought leaders. You also regularly spoke at Suerf events and contributed, I counted, so far, I emphasize, 10 Suerf policy notes and briefs, as well as other texts for Suerf studies and conference volumes. Claudio, it is with pleasure and privilege to count you in among the Suerf community, and now also to count you in among the very elitist group of Suerf honorary members. You have another one here, and to award you today Suerf's honorary membership. And for this, I have 3 things that I'm proud to hand over. First of all, let's start with the serious things. First of all, a document, which you can hang on your living room wall. Then second, also very important, a family album, so to speak. An album of photographs from Suerf events where you were active. And so apparently it were quite many over the years, and also the list of your Suerf policy briefs and notes, of course. And the third thing, we had intelligence among BIS colleagues. The third one probably is the most valuable to you. We got you some chocolate. And, we thought, well, okay, he's in Switzerland, so Swiss chocolate is not really a comparative advantage. Now, we are in Brussels. We could, of course, gone to some shops in the country of chocolate, but we opted for the third, for chocolate from the third capital of chocolates, from Vienna.
Let me just say just a couple of words. I'm really hugely honored to have joined a very small group of people. And of course, Suerf for me is something special, as you mentioned, 10 years on the council. It was set up by Lamfalussy. He was actually one of the founders of the thing. And just to let you know a little anecdote. Last year, 23, I was at the Institute on Central Banking Studies in Geneva, the institute that produces the Geneva report. And they were celebrating, I think it was their 30th anniversary and so on. I was on a panel and I was asked to talk about the importance of cross-fertilization between the 3 different communities, central banks, the private sector and academics. And I was obviously saying how important that was. But I also reminded them that in contrast to what they thought, they were not the first organization of that type that had been set up in Europe, because of course Suerf had preceded them by something like 10 years. And I have to say that over the last 10, 20, 15 years, actually since I left the organization, I hope it wasn't cause and effect. I mean, you've gone from strength to strength, and I really admire the work that, and I think the Secretariat has played an important role in all that. Okay.
May I now hand over to the highlight of today, the closing remarks by
Not
Governor
at all,
Wünsch.
but I'm going not at all on the highlight of the day. I wanted to explain why I wanted Peter to stay there. It's actually his birthday today. And you have people that get older without aging and pick up any number and it looks 10 years longer. Now, on the chocolate part of it, I have a friend of mine who was bored at his job, and so at my age, 5 years ago, decided to turn into making chocolates. So of course, this cannot be on the budget of the bank because I cannot have any privilege access to the budget of the bank. So it's my personal gift to you. But I will make some publicity that I can do. Bonaflora, it's a bio craft chocolate from Belgium.
Nothing to say. Thank you.
Okay,
I will taste them. I will taste them.
I just made an enemy. He didn't want me to do that, but I love them both, by the way. You're tired, and this is typically when there is a conference the most difficult part. Like everybody wants to go, they're fed up with it, and to be completely frank with you, some people, I'm your plan B because it was Steven van Ackeren who was supposed to make the speech, but we have had some technical issues with his mandate, so we hope he will be rejoining us soon. And so they've asked me to make the speech. And of course, they prepared a speech for me, which was the very official speech. So I was going to repeat again that we need to do the Capital Market Union and how important the financial stability is. And then I decided I don't want to inflict that upon you, especially because, honestly, I don't have strong views on Capital Market Union, so I would have been just repeating the official language on it. So if you can still bear with me for a few minutes, I thought I would just share some thoughts with you on the current economic and political situation. I don't want to talk about financial stability and monetary policy in front of Claudio and Peter. I can only lose, so I will just try to take some distance and talk about other issues. So, you know the song, What a Difference a Day Makes? What a difference 2 or 3 years make. I mean, look back, just travel in time with me 2 or 3 years ago. We just published the Green Agenda and all the documents going with it. We had a strong recovery after the crisis, and we were looking at a bright future. Of course, we had the war in Ukraine, and now it's all doom and gloom. So I guess my first message is probably the truth is somewhere in between. But still, I mean, there is a lot of attention now on the gap between the US and Europe in terms of productivity, innovation, share prices, and you name it. And of course, we have a new president in the US today. So just, again, sharing a few thoughts with you on that. And I don't think you can summarize the issue between the US and Europe by just saying we need a capital market union. I actually think it's part of a much broader issue of positioning, but to some extent also of deep choices that we make. First observation, we've been there before. The way I would characterize the situation today is Eurosclerosis 2.0, really. We've been there before. There is, in a way, not so much new. We are good at incremental technological progress. We are not good at disruption. And we are in disruptive times now, so we are not good. Just to remind you, we were never able to build good mainframes. We were never able to be competitive in the production of PCs until it didn't matter anymore because it became a commodity. So Eurosclerosis 2.0, and I'm of course referring to the first one after the oil shocks, and we are again after an energy shock. And there are some familiar foes that we've seen before. Difficult fiscal situation, we were there before. Less dynamic labor markets and others, over-regulation. What of course is different is back then we had a big problem with unemployment, that's much less so. But then the competitor and the disruptor was Japan, now it's China. China is bigger. And then of course the solution back then was openness to trade, liberalization, competition, and those were the consensus on which the recovery in Europe were built. And now we have climate, which is new, but we have discussion about deglobalization, tariffs, and again, discussion about industrial policy. So, history doesn't repeat itself, but it rhymes. To go back to how we got out of the previous one, and we had the very good 95 to 2005. It was again on the basis of building Europe, expanding, level playing field, rule of law, and autonomy of the Commission on the fields of competition and trade openness. That is going away. The 4 pillars on which we built after the oil shocks of the 80s are going away. Level playing field, forget it. We are living now in a transactional world. Rule of law, even in Belgium and Europe, we don't respect the law anymore, here and there, and it's going, I think, only going to get worse. And then again, competition, policy, and trade openness are being questioned. So we move to a world which is becoming transactional, where some people treat, or whatever X do now, and we have to coordinate among 27. So this is a game which we're going to have a problem playing on equal footing. And then, of course, we have populism. We have defiance against the elites, which is basically defiance against us. And sometimes it feels that we are a bit stuck between the US and China, US with the Magnificent Seven and cheap energy, and China, which has become extremely competitive with overcapacity in the green industries where we thought by being very ambitious we would succeed. EVs, solar, ever more wind, where China is being more competitive than us. So the way it can be summarized, and there was a paper with that title. I didn't read it, of course, because you don't do that anymore, but I should have tweeted about it. The US innovates, China imitates, and ever more innovates as well, and Europe regulates. And yes, now with the Draghi report, we can say it, we over-regulate in Europe. Okay, and of course, you know, and I'm a little bit coming to the topic of today, there is now the discussion of an omnibus directive to simplify what we just published, the CSRD, the CDDD, and all that, because there is some understanding that we've gone a little bit too far. And of course, in the Draghi report, beyond the attention to overregulation, there are a number of good points. I'm sometimes a bit, you know, puzzled about the figure of 800 billion, but then I'm being told this is not central to what Draghi told us. Okay, but, you know, and I know only 20% is supposed to come from fiscal policy or public money, but still even there, it's not going to be easy. But again, my point would be on Draghi, and it's a good report. French politics is not structured about a report by a previous prime minister. German politics is not being structured around a report by a previous prime minister. Why is it that in Europe, when we have problems, we ask someone to write a report, and then honestly, even before we've read it, we all agree that that's the solution and what needs to be done? And, you know, we've been there before. The Lisbon agenda, we were going to be the most innovative continent in the world, and then the EU 2020 agenda and the Juncker plan. We're still in the midst of next generation EU and not even capable of spending the money, and we are asking for the new plan. And I'm not against those plans, but I think at some point we should take some distance, and there is some repetition there, which is a little bit suspicious. And I love what Yanan Ganesh says in DFT. The US did not plan it. Actually, the US performance in terms of producing plans is dismal. So we have the plans, and they have the stars and the success and the positive market reaction. One way to summarize from my perspective the Draghi report, but really a very, very short summary, but which is, I think, a way also to point at some existential trade-offs. And that is maybe what I miss a little bit in Draghi, is the trade-offs. It's an and story. Today in Europe, we want to be more ambitious on the climate front. We want to remain open, an open economy, and we want to preserve the single market. And I would claim that's a trilemma, and you cannot have the three of them. You can, of course, decide to have openness and climate, but you have a subsidy war now going on in Europe to subsidize the heavy industry. You can say, okay, I keep openness and the single market, but I have to be less ambitious on the climate front, or the last one. But having the three together, and we see the tensions coming, you know, people arguing for a pause in terms of climate ambition. We see again, you know, subsidy wars, and we had them back then during or before the oil shocks in the 80s. But also CBAM and the discussion on tariffs on Chinese EVs. So we see tension there, and I think we need at some point to really reflect upon whether we can have all of that still together. By the way, on the tariffs, Trump's tariffs, I don't know what he has already announced or not. I had no time to check. I mean, in a way, if it's going to be 10%, it has already been absorbed by the exchange rate. So that would not be maybe my biggest concern. In terms of, yeah, I mean, I could be much longer, but I think it's time to conclude. What my claim would be, and again, coming back to Capital Market Union, we tend in Europe then to come with one or two ambitious plans where mostly, I think, our performances reflect deep political, economic, and cultural choices. They have ecosystems in the US because they accept and in a way like disruption, where we don't like disruption. We want to be in control. We want things to work our way. And maybe we should admit that sometimes it comes at the cost of being slower. Because when you look at the ranking, for instance, of the most livable cities in the world, we score very well. And frankly, I think part of the thing is just we don't want to be Americans, but we want to have the performances of the American economy. And I don't think that's going to work. So yes, there are a number of issues and domains where we can progress. The solution might not be always at the European level. Remember, only 1% of GDP in terms of fiscal power. But also, and if I may say so, more Europe and less regulation. That's going to be a difficult one. Let me stop there.
Thank you, Governor Wunsch, for sharing your insights. With this, dear public, we came to an end of today's conference. Let me thank you once again, all the speakers, for your valuable contribution, and the public, of course, for being present. It was a topic today that undoubtedly will be rediscussed in many fora to come for the next period. I would like to repeat what Mr. Servet also said earlier. The FSMA and the MBB have been publishing a report on the topic of today's conference, focusing on asset management and NBFIs in Belgium. Just last week, we have a fresh new report with new figures ready. You can find this information on our website. Now, all that's left for me to say is to wish you a very nice evening. I would like to welcome you back here in this auditorium for our next event, and that will most likely be on the 21st of February for the presentation of the annual report of the National Bank of Belgium. Thank you very much.